The committee will come to order. Without objection, the chair is authorized to declare a recess of the committee at any time. This hearing is entitled Oversight of Prudential Regulators, Ensuring the Safety, Soundness, and Accountability of Megabanks and Other Depository Institutions. I now recognize myself for 4 minutes to give an opening statement. Today, this committee convenes for a hearing with our nation's prudential regulators. Last month, we held a hearing with the CEOs of 7 of our nation's largest banks. In March, we held a hearing specifically focused on Wells Fargo and its pattern of harming its customers. Now we have with us today the regulators responsible for overseeing those institutions as well as other financial institutions. For some time, I have voiced concerns that the fines levied by our regulators against megabanks that break the law ultimately just amount to the cost of doing business for these institutions and do not effectively lead them to change their behavior. In the last 10 years, the U.S. global systemically important banks, that is the GSIB-S, have collectively paid at least $163.7 billion in fines for consumer abuses and other violations of the law. Over the same period, they made $780 billion in profits. In the last decade, Wells Fargo alone paid more than $11 billion in fines, but has raked in over $197 billion in profits. This institution has been engaged in widespread consumer abuses, including the creation of millions of fraudulent, unauthorized accounts, while Wells Fargo remains under an asset cap imposed by the Federal Reserve and has recently been publicly rebuked in statements by regulators. These steps do not appear to have gone far enough. Today, Chairman Qualls, Comptroller Otting, Chairman McWilliams must describe what additional steps they are prepared to take to rein in abusive megabanks like Wells Fargo. I'm also very concerned that the Federal Reserve, OCC, and FDIC have proposed weakening capital, stress testing, and other requirements for the largest financial institutions, and appear to be kowtowing to Trump's harmful deregulatory agenda. Checking items off of the to-do list provided by Trump's Treasury Department in a series of reports they have released, I want our witnesses to know that Congress is paying careful attention to your actions, and we will not tolerate actions that threaten the stability of our financial system. Additionally, in the wake of the passage of S-2155 last Congress, bank consolidation is accelerating, as I previously warned it would. The proposed BB&T and SunTrust merger would create the 6th largest bank in the United States. But while thousands of banks have proposed to merge between 2006 and 2017, not a single bank merger application was formally rejected by the Federal Reserve. Bank mergers should not simply be rubber-stamped by our regulators. They should provide a clear public benefit for the communities the banks serve. That is why I've called for the additional public hearings in states that would be affected by the proposed merger, as well as for regulators to defer a decision on the merger until this committee has an opportunity to thoroughly review the matter. I look forward to discussing these and other matters with our witnesses today. The chair now recognizes the ranking member of the committee, the gentleman from North Carolina, Mr. McHenry, for 4 minutes for an opening statement.
Well, thank you, Chairwoman Waters, for holding today's hearing, and I want to thank the regulators for being here. Almost a decade ago, Dodd-Frank resulted in more than 400 new regulations and nearly 28,000 new restrictions. That's more than the cumulative number of restrictions resulting from all other laws passed during the Obama administration. It was such a massive undertaking that federal financial regulators have yet to promulgate some of these rules 10 years post-crisis. Dodd-Frank was sold as the answer to consumer protection and financial stability, but it's resulted in increased costs for financial institutions and more headaches and paperwork for Americans as they try to open a bank account, get a mortgage, or save for retirement. 1 year ago, we enacted a bipartisan bill to balance the need for financial stability and consumer protection with regulatory right-sizing. The passage of the Economic Growth, Regulatory Relief, and Consumer Protection Act brought the proverbial pendulum back toward the center, offering targeted relief to put financial institutions back in the business of serving their customers, and by the way, the American economy. Last week, I wrote three of you on the panel about the faithful and swift implementation of this change in public law. Notably, the Volcker Rule, community bank capital simplification, tailoring for banks with more than $50 billion in assets, and improvement to the supplemental leverage ratio for custody banks, among others. These four alone have the potential to provide billions of dollars in banking services for institutions and retail customers. I urge you to swiftly implement and faithfully implement the contents of what we commonly call S-2155. Chairwoman Waters and I both agree consolidation is being driven by regulation, and the failure to swiftly implement this new law will drive more consolidation and the closure of more community institutions if it's not done. That's why we provided that right-sizing and relief for community banks and credit unions as well. The comment period is closed on these provisions, and it's critical that you work to implement this law without delay. Aside from new congressional mandates, many of the rules in which you're currently supervising merit modernization. Take, for example, the Community Reinvestment Act. CRA was enacted the same year Apple was incorporated to sell one of its first personal computers. Today, Americans conduct the overwhelming majority of their financial transactions by smartphone. Yet, the CRA hasn't seen even modest reform in more than a decade. That's problematic, and it no longer reflects the realities of a revolutionized banking sector. This needs to be updated. Better regulation can fix that. Finally, it's vital that you prioritize innovation and financial technology. FinTech holds considerable promise for institutions and consumers alike, and will play a significant role in compliance and risk management as well. It's important to ensure that banks can have the sound legal footing to partner with technology companies. The bank-FinTech partnership holds considerable promise for institutions and consumers alike. But if bedrock legal principles such as valid when made and true lender are not resolved by the regulators, the next wave of digital banking will be for naught. I look forward to your testimony and to the questions today.
The chair now recognizes the chair of the Subcommittee on Consumer Protection and Financial Institutions, Mr. Meeks, for 1 minute.
Thank you, Chairwoman Waters, for calling this timely hearing. And I wish to briefly flag some issues I hope to engage on with the witnesses that are here today and going forward. First, I'm very concerned about CECL. My main concern is the real-world impacts on small community banks, minority banks, and access to credit by the underbanked. I believe that we should seek to confirm and quantify the expected impact on these groups before implementing an accounting rule that has material real-world consequences. Second, minority banks are disappearing at an alarming rate. And following the financial crises, black home ownership is down to pre-civil rights numbers. We absolutely need to do more to promote MDIs and support minority communities' access to affordable credit. Third, I remain very concerned about leveraged lending. And finally, I've been encouraged to hear of the progress and collaboration across regulators on CRA modernization, and I intend to continue to monitor those issues. I thank you, and I yield back.
Thank you. The chair now recognizes the subcommittee's ranking member, Mr. Lukemeyer, for 1 minute.
Thank you, Madam Chair. The biggest news in the last few years has been our great economic progress. We've made unbelievable strides by overhauling our tax system, unleashing our economic potential, and fundamentally shifting towards a responsible regulatory environment. To keep this momentum going, we need cooperation between Congress and federal financial regulators, which is imperative. Today, we have before us 4 regulators who are charged with overseeing our financial system and ensuring all Americans have the economic freedom to participate in our growing economy. I would first urge all of you to implement the statutory changes included in S-2155 without delay, specifically tailoring for regional banks, community bank capital requirements, and supplemental leverage ratio for custody banks. Additionally, financial institutions across this nation are facing the most significant accounting change in decades. I've expressed my strong concerns over the broad potential impacts of FASB's CECL standard and urge delayed implementation until you all have thoroughly studied CECL and understand the consequences. Together, we must work towards smarter, streamlined regulatory regimes that promote not just transparency, but also effective taxpayer and systemic protections. I thank the panel for the willingness to work alongside Congress and for appearing before us today. Thank you very much, and I yield back.
Thank you. I want to welcome today's distinguished panel. The Honorable Rodney Hood, Chairman, National Credit Union Administration, the Honorable Yelena McWilliams, the Chairperson of the Federal Deposit Insurance Corporation, the Honorable Joseph Otting, Comptroller, Office of the Comptroller of the Currency, the Honorable Randall Quarles, Vice Chair of the Supervision Board of Governors of the Federal Reserve System. I want to extend a special welcome to Chairman Hood and Chairman McWilliams. Neither have testified before the committee, and we look forward to hearing from you. It has been over 3 years since NCUA or FDIC has appeared before the committee, so your appearances are long overdue. Without objection, all of your written statements will be made part of the record. Each of you will have 5 minutes to summarize your testimony. When you have 1 minute remaining, a yellow light will appear. At that time, I would ask you to wrap up your testimony so we can be respectful of both the witnesses and the committee members' time. Chairman Hood, you are now recognized for 5 minutes to present your oral testimony.
Good morning, Chairwoman Waters, Ranking Member McHenry, and members of the committee. Thank you for the opportunity to testify today about the state of America's federally insured credit unions and the NCUA's efforts to maintain a safe and sound credit union system. Federally insured credit unions are vital to the economic stability of communities across America. More than 1/3 of all U.S. households are members of credit unions. In 2018, the credit union system continued to perform well. By year's end, credit union membership grew to more than 116 million members, and assets increased to $1.45 trillion. The credit union system is well capitalized, with an aggregate net ratio of 11.3%, well above the 7% statutory requirement. The share insurance fund is strong, so strong, in fact, that we've been able to issue nearly $900 million in share insurance fund dividends over the last 2 years. Credit unions are using these funds to improve the financial capability of people of modest means, support small businesses, and strengthen communities across the country. My priority is to strengthen the vitality of the credit union industry by doing even more to bolster underserved communities, including those in rural areas, persons with disabilities, and low to moderate income households. To that end, I am working closely with the agency's senior leadership, especially the offices of Minority and Women Inclusion and Credit Union Resources and Expansion, to ensure that NCUA is doing everything we can to assist small and low-income designated credit unions, including encouraging the formation of de novo minority depository institutions. For example, we're helping credit unions navigate the certification process for becoming community development financial institutions. We're also providing grants to low-income designated credit unions through our Community Development Revolving Loan Fund. Last year, NCUA awarded over $2 million in technical assistance and urgent needs grants to 211 credit unions to help them develop new products and services, recover from natural disasters, and offer financial services to unbanked and underserved populations. Just last month, we entered into a partnership with the Small Business Administration to help credit unions better utilize the SBA's various lending programs. I further intend to leverage my expertise and experience as a former rural housing administrator at the U.S. Department of Agriculture in order to seek additional opportunities to connect credit unions and their members in rural areas to existing public sector lending programs. And next week, I have the honor of presenting a new federal credit union charter that will serve a Native American community. This low-income designated credit union will provide much-needed financial services to individuals and businesses in one of the nation's most underserved areas. On the regulatory front, we are constantly evaluating our regulatory framework to ensure that our rules are effective but not excessive. For example, we're in the process of providing federally chartered credit unions more flexibility under our Payday Alternative Loan Program, allowing them to safely offer less expensive small dollar loan options with a sound fidelity to consumer protection. Wherever we have the authority to improve the regulatory system and create a safe environment for credit unions and their members, we are doing our level best to do so. While the credit union system is strong and the NCUA is faithfully executing its mission, I remain focused on the various risks posed by the rapidly changing financial services landscape. Frankly, one of them, cybersecurity, keeps me up at night. Cyber attacks pose an enormous threat to the entire financial system, including credit unions. The credit union system is especially vulnerable to this risk because the NCUA lacks sufficient legal authority to directly identify and address systemic security risk within the system. However, strengthening our cyber defense is one of the NCUA's top priorities, and we collaborate regularly with our peer regulators on how best to address the challenges. As chairman, I intend to employ the resources necessary to combat cybersecurity threats and ensure data protection for the agency, the credit union industry, and its members. I want to close by highlighting an area where congressional action would help credit unions better serve their members and communities, especially those of modest means. Amending the Federal Credit Union Act to permit all types of federally chartered credit unions to add underserved areas to their fields of membership would promote financial inclusion and shared prosperity in underserved and distressed communities. I look forward to working with members of this committee on these and other legislative issues. Finally, I'll just note that my written testimony today details the information requested in the invitation to appear before you. Thank you for the opportunity to testify today. I look forward to your questions.
Thank you, Chairman Hood. Chairman McWilliams, you are now recognized for 5 minutes to present your testimony.
Thank you. Good morning, Chairwoman Waters, Ranking Member McHenry, members of the committee, and staff. Thank you for the opportunity to testify today about the FDIC's efforts to strengthen our oversight of depository institutions of all sizes and ensure that our regulated institutions are serving their communities. The nation's banks are at the center of economic activity in their communities, and this is especially true of minority depository institutions and community banks. The ability of community banks to provide safe and secure financial products and services forms the backbone of a strong national economy. For these reasons, the FDIC's oversight of banks is critical to financial stability and consumer protection. It is incumbent upon us to exercise our oversight judiciously and in a manner that recognizes each institution's unique business model and risk profile. My written statement details the many actions the FDIC has taken over the past year, both independently in cooperation with our regulatory partners, to ensure that we are appropriately addressing risks to the system and are not imposing unnecessary regulatory burdens that might impede safe and secure banking activities. The written statement also contains an update on the progress we have made in implementing the Economic Growth, Regulatory Relief, and Consumer Protection Act. In addition to our supervisory role, the FDIC is tasked with resolving failed banks and, if called upon, large bank holding companies and other systemically important financial institutions. The FDIC reviews bankruptcy planning requirements for the largest U.S. bank holding companies and the resolution plans filed by larger insured depository institutions. This work, along with other measures, has improved our readiness for these resolutions and helps ensure that market participants and not taxpayers bear the risks of loss in the event of a large bank failure. Most of my professional and personal life has been focused on the financial services industry. Before my tenure at the FDIC, I intuitively understood how important our nation's banks were to the economy. But until I had real conversations with bankers, their customers, communities that they serve, and state supervisors on my 50-state listening tour, I did not fully appreciate how our banks, particularly community banks and minority depository institutions, are so intimately involved in the fabric of their communities and customers' lives. I'm nearly halfway through my nationwide listening tour. Across the country, these banks help fund a town's grocery store, barbershop, restaurants, local libraries, and small businesses. In rural communities, urban settings, and low and moderate income communities, our banks provide a critical lifeline for low and moderate income customers while supplementing infrastructure and social services. It is the FDIC that provides consumers with confidence to trust these banks with their deposits. And I would be remiss if I did not mention the 6,000 dedicated FDIC employees who go to work every day, laser-focused on protecting the stability and integrity of our financial system. I'm proud to stand with them as we fulfill our mission to preserve and promote public confidence in the U.S. financial system. Thank you again for the opportunity to testify, and I welcome your questions.
Thank you very much. And I did refer to you as Chairman McWilliams. I understand that's your preference. I don't want to hear from the public that I incorrectly addressed you. Is that correct?
Chairwoman, any which way you call me is fine.
All right, thank you very much. Comptroller Otting, you are now recognized for 5 minutes to present your oral testimony.
Thank you very much. Chairman Waters, Ranking Member McHenry, and members of the committee. I'm honored to be here today to share my perspective on the condition of our nation's banking system and efforts to ensure banks serve their customers and promote economic opportunity for all, while still operating in a safe, sound, and fair manner. The nation's banking system's financial performance improved in 2018 and early 2019, driven primarily by strong operating performance. Capital and liquidity remain near historic highs. Return on equity is near
Excuse me, could you pull your microphone a little bit closer to you? Some of our members are having a difficult time. Thank you.
How's that? Is that better?
Is that better? Thank you.
Yep, I apologize. Net income increased 25% for banks with less than $1 billion in assets and nearly 50% for the federal banking system as a whole. Asset quality is measured by traditional metrics such as delinquencies, non-performing assets, and losses is strong and stable. While the condition of the federal banking system is strong, the OCC monitors risk to the system on a continuing basis and summarizes those risks in our semi-annual risk perspective. Key risks highlighted in the most recent report include credit, operational, compliance, and interest rate risk. These areas continue to evolve in the context of a changing economically, technological, and banking operating environment. Examiners will be paying close attention to these risks and the supervisory strategies for the banks they supervise. Maintaining the viability of the nation's economy depends in part on the ability of financial institutions, particularly community and mid-sized banks and savings associations, to operate efficiently, effectively, and without unnecessary regulatory burden. The Economic Growth, Regulatory Relief, and Consumer Protection Act of 2019 provided a common-sense, bipartisan framework to reduce regulatory burden for small and mid-sized banks while safeguarding the financial system and protecting consumers. The Act exclusively tasks the OCC with implementing regulatory changes that afford federal savings under $20 billion and assets greater business flexibility within the burden of changing charters. In 2018, the OCC issued proposed rules to implement this law. We plan to issue a final rule in the near future. In addition to this exclusive responsibility, the OCC is working with other regulators to implement additional common sense reforms, which we believe most will be completed by the third quarter of 2019, and all are scheduled before the end of the year. In addition to the required by the Economic Act, the OCC has acted to promote economic opportunity and eliminate unnecessary burden by working to to modernize the Community Reinvestment Act to increase investments in communities that need it most. In addition, we are focused with the other agencies to make the bank security compliance more efficient and effective, promote responsible short-term lending, and also support responsible innovation that provides more choices to consumers and businesses. The OCC has been a leader and recognizes the significant contributions our diverse workforce has made in achieving our goal. Towards this end, we work to enhance diversity within every level of our agency and among the institutions we regulate. The OCC has a diverse strategy for more than 10 years and regularly aligns its diversity goals with its strategic plan. Our recruiting efforts, including Hispanic serving institutions, historically black colleges and universities, and outreach to minority student organizations to develop relationships and gain access to diverse applicant pools. We offer paid intern programs to minority students at the college level, and for the first time in many years, we'll be doing that at the high school level this year to provide exposure and opportunity in financial regulation and financial services. I'm also very proud to say the OCC has a number of employee network groups that promote diversity, including Pride, dedicated to the LGBT community, the Coalition of African American Regulatory Employees, the Hispanic Organization for Leadership and Advancement, the Women's Network, the Veterans Employee Network, the Network of Asian Pacific Americans, and Generational Crossroads, which fosters communication across generations in the workplace. The OCC is equally committed to minority and women-owned businesses at all levels of the agency's business activities. Payments to minority or women-owned businesses represented north of 43% of the OCC's contractor payments in 2018. The OCC's actions to promote diversity amongst its banks it regulates includes regular technical assistance opportunities for minority deposit institutions and convening a minority deposit institutions advisory council to advise the OCC on conditions of the MDIs and steps that support their viability. Additionally, the OCC encourages MDI directors to attend agency workshops on governance, credit risk, compliant risk, and other important banking issues by waiving their participation fees. My written testimony provides additional details on all these topics. Thank you for this opportunity to discuss these important issues, and I look forward to answering your questions.
Thank you, Comptroller Arding. Vice Chairman Quarles, you are now recognized for 5 minutes to present your oral testimony.
Chairwoman Waters, Ranking Member McHenry, members of the committee, thank you for your time and for your invitation to testify today on the Federal Reserve's regulation and supervision of the financial system. Our visit today comes 10 years, almost to the day, after the Federal Reserve released the results of its first supervisory stress test. That exercise was an invention of both urgency and necessity, and a tool to move the country's largest financial institutions towards safety and stability. Many innovations from that period are now regular elements of the Federal Reserve's supervisory and regulatory work. These innovations have helped strengthen firms that were damaged by the crisis. They've given supervisors and the public a clearer view of risks in the financial system. They've provided a solid foundation for the nation's economic recovery. Now, when the financial system and economy are in good health, is the time to consolidate the insights we've gained with experience with these measures and to better the regulatory framework that we have built. Today, I'll briefly review the Federal Reserve's steps to improve this framework since my last appearance, outline the supervision and regulation report that accompanies my testimony, and discuss our other engagement on community, consumer, and financial stability issues both at home and abroad. Almost a year ago, Congress passed the Economic Growth, Regulatory Relief, and Consumer Protection Act. A cornerstone of this legislation was a directive to the regulatory agencies to tailor oversight of institutions to ensure that our regulations match the character of the firms we regulate, with specific congressional direction for firms between $100 billion and $250 billion in total assets. The core of the resulting regulatory efforts were the tailoring proposals for domestic institutions that the agencies issued last year. Those proposals share a common goal: to focus our energy and attention on both the institutions that pose the greatest risk to financial stability and the activities that are most likely to challenge safety and soundness. A more recent proposal addresses prudential requirements for the U.S. operations of foreign banks. Like last year's tailoring proposal for domestic institutions, it categorizes firms according to their size, business model, and risk profile. The proposal differs from the domestic proposals to account for the unique structural differences of foreign banks and asks for input on a number of important issues. I look forward to reviewing the comments we received. We also have been providing targeted regulatory relief, especially for community banks and other less complex organizations. The community bank leverage ratio would give community banking organizations a more straightforward approach to satisfying their capital requirements, for example. We also propose to expand community banking organizations' eligibility for both longer examination cycles and exemptions from holding company capital requirements. The report accompanying my testimony provides more details on these and other recent regulatory steps, as well as on the overall condition of the banking system. In the past half year, the board also took steps to consolidate the role that stress testing plays in our work. Following the directive from S2155, we began to transition less complex firms to an extended testing cycle, reflecting the lower risks they pose relative to their larger and more complex peers. We published new details of our methodology and models, improving public understanding of the program and maintaining the integrity of its results. We announced the new stress testing conference that will take place in July to receive additional input on our practices. And while maintaining a rigorous evaluation of capital planning, we committed to addressing qualitative deficiencies at most firms through supervisory ratings and enforcement actions rather than through a standalone qualitative objection. As detailed in my written testimony, we've taken other steps that support our supervisory and regulatory framework by making it simpler and more transparent. We also continue to engage with our regulatory counterparts overseas through standard-setting bodies and the Financial Stability Board, where I recently began a 3-year term as chair. The strength of our financial system today rests on the insight, patience, and persistence of a decade's work on post-crisis reforms. Only by thoughtfully evaluating the reforms we have made and adjusting our approach when appropriate, can we preserve and improve the efficacy and efficiency of our regulatory framework? Thank you. I look forward to answering your questions.
I now recognize myself for 5 minutes for questions. Over the last decade, bank merger applications have been approved at record speed and with little opposition from regulators. According to the Federal Reserve, the median time it takes to approve a bank merger receiving opposition from community groups dropped to less than 4 months in the first half of 2018, and that compares to 7 months for all of 2015. From 2006 through 2007, over 3,300 merger applications were approved by the Federal Reserve, and the agency did not formally reject any merger application they received. Regarding the proposed BB&T SunTrust merger, I received letters yesterday from the Federal Reserve and FDIC that were non-responsive to my recommendation that additional public hearings in other states be held beyond the 2 hearings previously held. Yesterday, I also learned from the CEOs of BB&T and SunTrust that the banks held 6 additional listening sessions in other states, though it is unclear how public those meetings were. Vice Chairman Qualls and Chairman McWilliams, given the banks themselves have done additional listening sessions, what is the harm in your agency scheduling additional public hearings in other states that will be affected to ensure your agencies receive as much feedback as possible about the benefits and drawbacks before deciding on this proposed merger? Vice Chairman Qualls?
Thank you. We have had an active process of seeking public input in addition to the 2 public hearings in the 2 key areas that are where the banks operate. We've received public comment 801, actually. One came in yesterday, 801 public comments on the merger. There's really no shortage of public input, and we're in the process of evaluating that.
In talking with the CEOs, they said they have no problems with having additional hearings. If they have no problems, why are you hesitant to have more public hearings?
As we look at approving any merger, including this merger, we are mindful that we do have a congressional framework that establishes what it is that we look at and the timeframes in which we are to look at them. And we are trying to balance, and I think we're doing a good job of balancing the need for public input, particularly on a merger of consequence like this, and we have gotten a lot of public input with the congressional mandate to act in timeframes and considering, and with the considerations that we are directed to use.
I've been around for quite some time, and I can recall the days when we had many public hearings on proposed mergers. And I want to just continue with asking Chairman McWilliams, do you have any problems with having additional hearings?
We have held 2 hearings at which we have received a sizable number of comments. And frankly, I think I pulled the numbers. We have heard from groups and individuals from 24 different states and the District of Columbia, and heard from individuals from 14 different states in DC at those 2 public hearings. We have covered the majority of the markets that both BB&T and SunTrust serve at those hearings with representatives. It is my understanding from being briefed by my staff on how the hearings went and what was said at those hearings that over 90% of groups speaking at those hearings were speaking positively of the merger. What we heard at those hearings and what we are looking at throughout the process did not seem to imply that we need to do more hearings.
So how many states are we talking about this merger impacting? How many states do they have banks in?
So the hearings were held in the 2 home states.
I know, only 2 of how many?
Well, I don't know exactly what they're, we can get you the numbers on the footprint for both banks, but representatives
I'm
from
trying to
24
get
different states
to
were
make the
present.
point that while there were 2 hearings, you have any number of other states that are impacted by this merger. How many other states, if the staff can give me that
So
number?
we actually have, I have the numbers. Individuals from 12 of the 16 markets that BB&T serves appeared at the hearing, and individuals from 9 out of the 11 markets served by SunTrust.
And so I am questioning why you don't have more hearings. This is an important merger. This will be, I suppose, the 6th largest bank in this country. We're concerned about consolidation, and we are concerned about making sure that the public is involved in understanding what is happening. And so I am going to insist on asking you again in a formal way, by way of a letter, about consideration for additional hearings. "12 states. All right, thank you very much. I will now yield to the gentleman from North Carolina, the ranking member, for 5 minutes.
Oh, well, thank you. Vice Chairman Quarles, Comptroller Otting, and Chairwoman McWilliams, thank you all for your interagency response to my letter. I've never seen such a timely interagency response, and I'm grateful for that. And the clarity you gave me and the questions I outlined, I appreciate. And as a matter of congressional oversight of the implementation of public laws, that ongoing process is the assurance that we will have faithful implementation of our laws in a way that's conforming with congressional intent. And you outlined in your responses, there are a number of comment periods that have closed. But I also know there's a significant amount of work to be done on your part and your staff. What I've heard around town is there are bandwidth issues, which is, we don't have the capacity to get these things done. It's a lot of work. Then I look back at the Obama administration, I never heard complaints about bandwidth issues. And there are a lot more regs to implement then. And so I just want to ask you, do you currently have within your capacity the staff, the necessary ingredients to get these rules enacted in a timely fashion? Vice Chairman Quarles, and I'll ask you, Mr. Otting and Ms. McWilliams.
Yes, yes, we do. We are, as I think we indicated in response to our letter, the bulk of the core proposal, which came out last October, was. We don't keep detailed records of this, but I feel quite confident in saying that that was the fastest proposal of an implementing regulation of a major congressional action in the history of the Federal Reserve, certainly in the modern history of the Federal Reserve.
We had 10 years to prepare, so that helps.
And we are on track to complete the implementing actions for S2155, have the bulk of the implementing actions completed by the third quarter of this year, and all of them completed by the end of this year.
Thank you. Mr. Otting.
Yeah, I think there's been a tremendous amount of communication. We also divided the rules. The common process is one of the agencies will take a lead on a particular rule, so we've divided these rules, so call having the pen. But I would also say probably what has worked effectively is the three of us speak almost every week, and any items that are outstanding on 2155, we bring them right to the top. All of us pretty much probably carry in our briefcase the matrix of where we were, so we are acutely aware of the necessity to move those rules through the process. And I actually think we've had good cooperation and have had no bandwidth issues as we've tried to move both this and some other legislation forward.
The FDIC has highly capable staff that will complete the rulemakings in due time, and we work very well with our partner agencies.
That's good. So, to you, Ms. McWilliams, and you, Mr. Otting, there's the ongoing question in the Madden versus Midland case of the question of valid when made. And my question to both of you is, will you commit to providing clarity to banks and non-bank third parties as it relates to the foundational legal principle of valid when made? Mr. Otting?
Well, first of all, we do think that was an inaccurate conclusion in that case. We had hoped for perhaps some legislative fixes to that, but it does appear now we'll have to have some regulatory fixes to that, and we've begun the discussions within the agency.
And the issue of federal versus state law in banking cases is not new. What's new is that it comes at the time of great innovation that could stifle entrepreneurship and progress in how banks are able to conduct business. So we're currently examining at the FDIC the appropriate role of the agency as this case unfolds.
Well, time's ticking, and I'll follow up with both of you on that. Mr. Quarles, I'll have a number of questions for the record about the switch from LIBOR to SOFR. The concern here is the disruption in the marketplace. Is that a concern you share in this shift from, LIBOR to this new benchmark standard?
It is. I think, that's the reason that we began catalyzing the private sector response to this really beginning 7 years ago. The Federal Reserve was indicating that this needed to be done. I think as people think about the LIBOR transition question, it is important to remember that this is not a result of regulatory action. We are not mandating the transition from LIBOR. We're recognizing that the private sector banks that are responsible for determining LIBOR will no longer do so after, or certainly very well may no longer do so after a period.
I'll submit more questions for the record on LIBOR versus SOFR.
Thank you. The gentlewoman from New York, Ms. Velasquez, is recognized for 5 minutes.
Thank you. Thank you, Madam Chair. Comptroller Odin, last month I questioned Citigroup CEO Michael Corbat on his $24 million compensation package for 2018. This outstanding package means Citigroup CEO makes $486 for every dollar that the median employee at the firm is paid. When I asked him if he thought this ratio was fair, he responded by saying that his compensation is set by the board and voted on by shareholders. Section 956 of the Dodd-Frank Act was created to prohibit excessive compensation packages in the financial industry that encourage inappropriate risk-taking. However, a rule has never been finalized. Last month, you stated that the OCC was planning to take the lead and propose a rule on executive bonuses for bankers. What step is OCC currently taking to move forward with this rule?
Well, I'm actually pleased to make some comments on this because I know it has been a very topical issue. If you may recall, in 2011, there was a notice of proposed rule that was introduced that stalled, and then 2016.
Yeah, I know that history, but my time is limited.
To that, lay the history. I would say where we are right now is we're doing in a succession of this. Right now, the OCC has put a draft together. We've shared it with the SEC. We've met with them. The next plan is to have, once the two of us sign off on that, is to engage the other 4 regulators. And we are hopeful that this year yet we can introduce a notice of proposed rule.
Can you share with us regarding that draft if it contains any specific restrictions? We need a rule that contains actionable requirements.
There are provisions in the Dodd-Frank, and we intend to fully include all the provisions in Dodd-Frank as required.
So it's going to be a strong rule, strong enough?
Well, I can't comment on specifics of the rules until I get feedback from the other agencies. This is a 6-agency process, as you probably recall. And it is our intent to try to get this, clearly with the principles based of the rule incorporated into the document.
So we hope that it has and it contains strong requirements, because if we see what happened recently with Wells Fargo, if you don't come out with a strong rule, then you're failing the American people. You're failing the thousands of families that lost their homes. Comptroller Odin, your desire to update and modernize the Community Reinvestment Act has been well publicized. You have stated that a proposed rule could be released by December. Do you still believe this is a realistic time frame?
As you know, this is a very complicated rule. A lot of public input up till now. I think we have 2,500 either meetings or public input. We are in the stages right now in discussion with the Federal Reserve and the FDIC and ourselves. I'm hopeful of that, but this is, you know, a highly complex thing that hasn't been looked at since 1977. It would be my goal. You know, clearly we want to be able to measure what gets measured, where it gets measured, how it gets measured, and more importantly, what's the aggregation in the industry that gets done on an annual basis.
Sir, do you believe that this proposal will be a joint proposal?
I do.
Mr. Quill, what is your opinion on that?
Yes,
Any
I agree.
comments? It's going to be a joint proposal?
The agencies are working well together. I expect it to be a joint proposal.
Chair McWilliams, how would you respond to what Comptroller Odin and Chairman Quirrell just said?
I am in agreement that this should be a joint rulemaking, and we're working very hard. We're meeting every week at the principal level to discuss the issues and make sure the agencies are aligned. It's always good to have a joint rulemaking for matters that are of this important to the communities, and we hope to proceed together.
Are there any stumbling blocks that remains from your perspective?
So it's, as a former regulatory attorney at the Federal Reserve who used to draft regulations, I can tell you once you start working on the nuances of each line, that's where you kind of jump into some of the difficult issues, but so far we're aligned.
Thank you. I yield back.
Thank you. The gentlewoman from Missouri, Ms. Wagner, is recognized for 5 minutes.
Thank you, Madam Chairwoman. On May 24th, 2018, almost a year ago, President Trump signed into law what we've been speaking about, S-2155, the Economic Growth, Regulatory Relief, and Consumer Protection Act. These reforms will improve economic growth and competitiveness for financial institutions and their customers, and I am eager, as are many of my constituents, for them to move forward. I'm going to ask each of you for a very fast, lightning round update on the implementation of proposed rulemakings from S-2155 that have a closed comment period. There are approximately 8 of them. I'm glad you have that matrix, Comptroller Otting. Here we go. Number 1, Section 214, promoting construction and development on Main Street. Mr. Quarles, Mr. Otting, Ms. McWilliams.
Congressman Wagner, you're asking us, when do we think that would get completed?
Yes, I want the status, the update, like what is the status currently?
I would say 60 days.
Mr. Quarles, Ms. McWilliams, yes?
Sounds correct, yes.
Okay. Next, number 2, Section 401, enhanced supervision and prudential standards for certain bank holding companies. Mr. Quarles.
Yeah, anything on which the comment period is closed, I think we will have a final rule on within 60 to 90
Within
days.
60 days? 90 days?
60 to 90, yes.
60 to 90. Section 201, capital simplification for qualifying community banks. Mr. Quarles, Mr. Otting, Ms. McWilliams. 60, 90, 30, 10.
60.
Going with 60. Number 4, Section 203, Community Bank Relief Act. Mr. Quarles, Mr. Otting, Ms. McWilliams. I like it.
Final rule expected August 2019.
August 2019. All right, good. Number 5, Section 103, the rural area appraisal exemption. Mr. Quarles, Mr. Otting, and Ms. McWilliams.
60 to 90 days.
Oh, come on. I need better than that. Mr. Otting.
I am trying to find it in my chart.
I love your matrix. Can I just get a copy of your matrix, sir? No,
Pardon me?
no, sorry, teasing.
You know, as we said, I said in my opening comment, almost all of these will be done by September 30th. A couple are going to move into the 4th quarter, but all are expected to be.
Well, which ones will move into the 4th quarter, do you think?
Pardon me, ma'am?
Which ones will move into the 4th quarter, do you think? Look at the staff working behind you. This is great. Team effort. So as not to waste time, Section 103, rural area appraisal exemption.
I don't know why I don't have
Mr. Quarles, Mr.
Final
Otting.
rule expected by July 2019.
All right. Section 204.
We would be more than happy to provide all these dates to you.
That is outstanding. I thank you very, very much. And I will then.
Mr. McHenry could provide you a copy of our letter.
That would be just dandy. Thank you very, very much. It's very important that we get these done, especially those that have closed the comment period and move forward with this tremendous piece of bipartisan legislation. Let me ask another question here. Pursuant to the Dodd-Frank Act, you promulgated the Volcker Rule in 2013, a highly complex and burdensome regulation restricting banks from engaging in proprietary trading or investing in covered funds, despite the fact that prop trading in commercial banks was not central to the economic crisis. Last year, you proposed amendments to the rule to address some of the burdens. And finally, last May, as part of Senate 2155, Congress acted to alleviate some of the harmful aspects of the Volcker Rule. Where do things stand on comprehensive Volcker Rule reform, as well as with regard to implementing the provisions in 2155?
I can address that. So that we have received hundreds of comments on the Volcker Rule proposal, as both the Volcker Rule itself and the comments are extremely complex. The relevant agencies, there are 5 affected agencies together, have been reviewing those comments. Our expectation is that we will have responses to those comments and a conclusion as to how to respond to them soon, within the next, I would say within the next couple of months, over the course of the summer, certainly, we will have that response. Necessarily, because on the covered funds issue, as you know, in the proposal last year, we asked questions as opposed to having a specific proposal on covered funds. There will be at least a initial proposal of what to do on covered funds, and therefore an additional comment period and some process on that afterwards.
Thank you. My time's expired. I yield back.
The gentleman from California, Mr. Sherman, is recognized for 5 minutes.
It's been a pleasure to sit next to my colleague, Mr. Meeks, for the last 20 years, and I join him with concern about CECL, but I think it's up to us to solve the problem, although I'd like you folks to respond to the record as to what we can do to solve it. As Mr. Meeks points out, it will be bad in its effect. I'm here to tell you it's bad accounting theory, and the process that the FASB took to get this far is less democratic, less open, less transparent than any other government agency I'm aware of, although they will tell you it's better than the way they did other things. So it's up to this committee to step in and get the FASB to delay, and if they don't, to actually pass legislation withdrawing the CECL regulation. Mr. Hood, I couldn't agree with you more that credit unions need to be allowed and, in fact, encouraged to serve the underserved, and, of course, all regulators should be not only allowing but encouraging their institutions to do just that. I've got another question for the record, but I'd like you all to respond for the record, and that is, what can you do so that we can make small business loans beyond those guaranteed by the SBA? Because I remember when Jamie Dimon was there, and he said we couldn't find any U.S. businesses, small and medium-sized businesses, to make loans to. We had this capital, so we sent it to London, where it was eaten by the whale. You remember the whale. So the fact is, nobody's making a prime plus 5 loan. They say it's your fault. It could be quite reasonable for a bank to make some of those loans because there are businesses that have a significant risk, but are the small businesses that will eventually be very important to our economy. LIBOR is an index used in $400 trillion worth of instruments that are out there. 400 trillion here, 400 trillion there, eventually adds up to real money. Of those, about only 2 trillion are what I call legacy LIBOR. That is to say, they're going to be outstanding after 2021 when the LIBOR index is no longer published, but they reference LIBOR and they don't have a provision in there to say what's the backup reference. And I wonder if you could work together to give us proposed legislation to say, okay, this is a matter of contractual interpretation. We'll simply mandate that for the 2 trillion of legacy LIBOR, this is how you do the math. And I hope that you would respond for the record to that. About 10 years ago, we had TARP. Mr. Quarles, I think you probably regulate the biggest of the big. Can you guarantee us that no one institution will be able to call the White House or Congress and say, we're going down, and when we go down, we'll bring down a chunk of the economy with us? They did that 10 years ago. Can we just hang up on them now if they make that call? And don't tell me it's unlikely to happen, because it was, trust me, your predecessor's predecessor told us in 2007 it wasn't going to happen. Go ahead.
There have been substantial improvements in the resolvability of all of the large institutions.
So can you guarantee that if they call, we can hang up the phone? You're not going to be here saying, oops, you better pass TARP 2.
What I can guarantee is that the changes that have been made will give policymakers, including the Congress, more options than existed 10 years ago, which could include
For those of us who lived through it, that's not a whole lot of comfort. I tell you, we can guarantee that if we break up the too big to fail institutions. And I'm still looking for co-sponsors, particularly bipartisan co-sponsors on that effort. Let's see. Let me go back to Mr. Hood. I believe that the nominal operating level for your reserve fund is 1.3%, but as a result of recent changes, you're now up to 1.38%. Is it your intention to go back down to 1.30?
Yes, sir. I am looking at this with agency leadership and staff. In the month that I've been at the NCUA, I've had 2 briefings on the matter. I am pleased to report that we have been able to issue over $900 million in dividends back to the credit unions. So we are continuing to assess and address operating levels.
Thank you.
The gentleman from Oklahoma, Mr. Lucas, is now recognized for 5 minutes.
Thank you, Madam Chair. And panel, I'd like to turn to an issue that I think is close enough at hand and something you can do something about in short order. I've raised the issue of inter-affiliate margin several times with each of you. By now, I think you all know the reasons why regulators should clarify the treatment of inter-affiliate transactions when it comes to initial margin. Just to reiterate, you are the only G20 regulators who still require initial margin for these transactions. I also know you've heard from my colleagues both on this committee and in the Senate about this issue, so I will not belabor the point. Chair McWilliams, can you update me on the progress in harmonizing your rules with the CFTC as Treasury recommended to you in 2017?
Thank you for that question. We are, on the interagency level, we're working together to update the rule, and we expect to seek comment in the near future on how to proceed. There are several ways to proceed. One would be an interagency rulemaking. One of the other regulators has sole authority to act as well. So it's a question of how exactly are we going to proceed, but we're committed to proceed in the near future.
Vice Chairman Quarles and Comptroller Auditing, can you offer any thoughts or updates on this situation?
Yes. So the inter-affiliate margin question should be considered in the context of the existing provisions of the Federal Reserve Act and Federal Reserve regulations that provide protections to affiliates of depository transactions between depository institutions and their affiliates, 23A, 23B, and Reg W. And I think that existing framework should give us comfort as we look at removing the potential redundancies in the inter-affiliate margin rules.
Well, I'm pleased to hear that we're making progress on some of this, or at least some movement. And it's been a long time coming, and will lead to healthier derivatives markets for everyone. That said, the time, I believe, for change is now, quicker being more important than later. And I've been discussing this issue for almost 5 years. And I would charge you to continue the forward momentum that we have right now. Now, I understand there's some discussion of adopting this rule in a larger notice and a comment review of the margin rules or prudential regulations. I fear, however, warranted these broader efforts may be, incorporating a fix in an inter-affiliate margin will only delay a badly needed policy change. Instead, I encourage you to address this issue through a discrete, yes, sometimes in Congress we advocate discrete actions, discrete change in the margin rules that can advance independent of a larger undertaking. You have made such changes before these rules, so please let's do that again here. Let's make this happen and bring us into balance with the rest of the G20. Now that said, I sent a letter yesterday to the Fed, FDIC, OCC on the SACR proposal. Specifically, I'm worried that the higher capital charges under SACR will cause banks to pass those costs on to end users engaged in OTC transactions. As a member of the Ag Committee and this committee during the Dodd-Frank process, I can tell you that we did not intend for legitimate hedging by end users in the derivatives markets to be penalized in this way. End users should have access to these markets to engage in prudent risk management practices. Vice Chairman Quarles, we've discussed this in person. Have you heard these same comments from end users? And if so, do you intend to address them in the final rule?
I have heard those comments from end users, and I'm meeting with a coalition of end users again in a few days where I expect to hear additional detail on them. And we're giving that careful consideration as we consider how to respond to comments on our proposal.
I'm proud that the constituents are making it clear to both you and I. Another SACR question for you, all related to an offset for client margin and supplemental leverage ratio. In February, all of the CFTC commissioners, Democrat and Republican, sent a comment letter to the Fed, FDIC, and OCC raising concerns about the SLR. Specifically, not offsetting client margin has had bad effects on the derivatives markets for end users seeking to hedge risk. Are each of you aware of the CFTC comment letter, and have any of you discussed it further with the CFTC?
Yes and yes.
Well,
I work, as all of us do, and we work quite closely with Christian Carlo on these issues, how bank regulation affects trading in the derivatives markets.
my final comment simply is I would heed you or encourage you to heed the CFTC's advice before publishing a final rule. They all agree on this regardless of partisan affiliation and directly oversee those markets. Yield back, Madam Chairman.
Thank you very much. The gentleman from New York, Mr. Meeks, who is also the chair of the Subcommittee on Consumer Protection and Financial Institutions, is recognized for 5 minutes.
Thank you, Chairwoman Waters. Let me start out with Chairman McWilliams. I have two letters, one from the National Bankers Association and other from the Abacus Bank in New York, and I'd like to submit those letters for the record. With that, Madam Chair, I'd like to submit these two letters for the record.
Without objection, such is the order.
So, Chairman McWilliams, these are two small MDI, one is a small MDI bank serving underbanked Chinese communities. And these MDIs express their concern that CECL implementation may increase the cost and availability of loans to their core clients, namely minority communities and low and moderate income. So my question to you is, do you believe that there is any credence to these concerns, and can we confidently dismiss this risk without conducting a quantitative study?
Thank you for that question. I have made it a point to go to different states and meet with bankers, and I have to tell you, the first question that comes out from in these meetings from community bankers, including MDIs, is CECL and their concerns about implementing it. As you know, that rule is promulgated by FASB. So long as U.S. banks have to follow U.S. GAAP, which is a statutory requirement, FASB is in charge of U.S. GAAP measures. Our hands are somewhat tied. I do believe that banks are faced with uncertainty about how to implement it. There are many different ways of implementing it. The FDIC has held workshops to help banks navigate this process without having to hire outside consultants and pay a lot for the implementation systems, and we'll do whatever we can to ease the implementation burden on the banks. But the rulemaking itself is, including the studies and et cetera, is outside of our purview. It would have to be done by FASB.
So tremendous concerns because, there's a rapid disappearance of MDIs, and, that's a major concern of mine also. And your organization generally tracks this also, I believe. So what are you doing to increase the number of de novo MDIs to support and provide technical assistance to existing MDIs, and importantly, to prioritize MDIs in acquiring branches or operations for many of the failing banks?
I have made the minority depository institutions a priority of mine since I came to the FDIC last June. We have now a dedicated coordinator for MDIs across the country. We have done a lot of additional technical assistance. I have increased the membership on our Community Bank Advisory Committee from 1 MDI to 3, so now 1/6 of the committee is MDIs. I have met with a number of MDIs throughout the country, including in states like California, Atlanta, et cetera. We are also holding roundtables. We have a roundtable with 110 MDI CEOs scheduled for June of this year, where we'll allow them to engage with each other on both kind of like exchanging the best practices and as well as providing technical assistance and workshops. And the workshops will focus as well on how to train MDIs to prepare a successful bid for some of these branches and mergers and acquisition of other banks.
Thank you. And I'd like to follow up with you at some other time. My time is
Thank
limited
you.
here, but I would love to follow up because that's a tremendous concern of mine also.
It is mine as well. Thank you for that.
Let me go to Mr. Quarles real quick. The general argument right now is that leveraged lending may be a recession amplifier, but does not pose a system risk, in part because only 12% is held in the banking system, and much of it is held by patient capital. But isn't there a model correlation risk, specifically asset quality or concentration rules that may force CLOs funds into synchronous sell-off of these debts in the event of a general credit downgrade of the underlying assets?
Our analysis of the CLO holding structure is that that there's not a risk of sort of a financially destabilizing run from those institutions, even if there were a significant repricing of the leveraged loan assets that the CLOs hold.
Even if the economy was softening?
Yeah, even if the economy were softening. But as you said at the outset, a separate and important question is that a repricing of those assets could have a magnifying effect on a business downturn. We don't think that that would turn into a financial stability problem. But if these assets were to reprice substantially, given the increase in volume there has been of them, the investors in them would lose money, clearly, and that could exacerbate a business downturn.
Thank you. My time has expired. Yep.
Thank you. The gentleman from Missouri, Mr. Lukemeyer, is recognized for 5 minutes.
Thank you, Madam Chair. Thank you all for being here today, and you certainly have brought a breath of fresh air from the standpoint to your positions from the standpoint of having some real-world experience besides being a bureaucrat. So now you're bringing some of that expertise in, and we appreciate that. Mr. Hood, my first question is for you. You know, I'm very concerned about CECL. I have requested from numerous associations and entities with regards to the effect on it. And two of your credit union associations, NAFQ and CUNA, and gave me some information here. And let me just read from their studies. NAFQ says that almost everyone's capital is going to be negatively impacted in some way. There's going to be a rise in the cost of credit to the consumer. There's going to be constraint in the amount of credit available. The credit unions are going to be making fewer loans to members, primarily in the mortgage and commercial loan space. And the real kicker to the whole other thing here is their chart on the back that shows there's going to be a $30 billion hit to the capital accounts of the members of this association. That is significant. CUNA did a study. Their numbers came back, completely eliminate specific loan offerings to reduce the CECL impact. 15% likely will do that. To tighten credit standards to offset or reduce CECL's impact, 31%. And increase loan rates or increase loan fees to offset or reduce CECL's financial impact, 35%. Would you like to comment on that?
I share the concerns that have all been raised by the industry groups you've cited. We as an industry or we as an agency are also doing our own internal studies with our chief economists. I find the operational burdens that are going to be imposed by CECL to really be really difficult for a lot of our smaller credit unions to manage and operate in that environment. We, though, will need more assistance from FASB to address some of these issues. I do have a little bit of comfort in that a lot of our institutions, whether they be credit unions or community banks, will be exempted from doing a lot of the complex formal forecasting that's required.
This will affect their customers, will it not? In fact, when you start talking about raising costs,
It could have a
and
deleterious
restricting
impact on
credit?
their ability to, yes, sir, it could have a
We
deleterious
had,
impact on
we
their
had
ability
the
to
home
serve.
builders in here twice already, and they made a comment, $1,000 increase in the cost of a home loan, 100,000 people across the country no longer have access to funds. That is a devastating number. Mr. Quarles, and Mr. Otting and Ms. Williams and Mr. Hood, one quick question here for each one of you. FASB admits they did not study this. They did not do a cost-benefit analysis. They didn't study the economic impact across the country or on consumers. This is a huge rule that they're proposing, similar to what they did with mark-to-market. And look at the disastrous result of exacerbating the downturn, in my mind, is what happened with mark-to-market before they had to pull it. Would you, Mr. Quarles, Mr. Otting, Ms. Williams, and Mr. Hood, do your agencies go out and make a rule of that nature and not study it and not have a cost-benefit analysis on it? Mr. Quarles?
We're required, and I think it's good practice to have a good cost-benefit analysis of any rule.
Mr. Otting, would your agency do that?
We would not.
Ms. Williams?
It is always good practice to provide and conduct analysis before you
Mr.
know
Hood?
your
We would also, I agree, we will conduct an analysis and use our chief economist to come up with a cost-benefit
So
analysis.
wouldn't it be great if all of you would ask them to pause on this and do a study to see the impact, because it's going to have a dramatic impact on all the entities that you regulate?
Yes, sir, I would be willing to look with them, work with them on that, especially because of credit being managed to underserved communities.
Ms. Williams, Mr. Diamond from JP Morgan was here last week and asked the question of it with regards to the impact. And he came back with this comment. He said, look, my bank is big enough, we don't have to worry about this, we can absorb the cost. But he said, there's a lot of small banks and credit unions that can't. You're going to see a huge problem with them with regards to pricing on this. And then he said, some will virtually have to stop lending because of the pro-cyclical nature of this thing when we have an economic downturn. Would you agree with that?
Based on my exposure and interactions with community bankers, that seems to be a prevailing opinion among the community banks as well.
Fantastic. With that in mind, here we have a situation where we have a rule that is being implemented. It's not been studied. It's going to have a dramatic impact on the economy, on the very entities that you all are reviewing and regulating. And are they going to have to, the pro-cyclical nature, this to me, the pro-cyclical nature of this thing is what's devastating, because whenever we have a downturn in the economy, they're going to have to find a way to raise more money, more capital, and have to probably cut back on services and lending to the very people who we want to be able to help. I would hope that you'd be working with me to be able to put some pressure on FASB to be able to just stop and study this, and I appreciate your continued studying of this and working with us. Thank you very much. I yield back.
The gentleman from Georgia, Mr. Scott, is recognized for 5 minutes.
Thank you very much, Chair Lady. We need to put a stop right now on FASB's ruling in terms of CECL. This ruling is absolutely devastating to our smaller banks, without question, and our credit unions. The larger banks don't have to worry about it. They've got the capital. Now, I've been on this issue for quite some time. In December, I even brought up the issue of comparability. As you know, CECL does not prescribe to the use of specific methods to estimate loss allowances. And what this does, it allows these banks to be able to use their own judgment in developing methods that are appropriate and practical under those circumstances. And this is done to allow these banks who are smaller to have flexibility, and I agree we need to respond to that. But here is the situation. It brings into this a conflict, an inherent conflict. And I want Chair Lady McWilliams and Chairman Hood, if you would explain to us, how do you balance flexibility against comparability? Meaning, how can you ensure the judgment banks use in developing their methods does not impede upon the ability of regulators like yourselves and investors to compare the health of the banks across the industry, and will not limit the smaller banks and credit unions from being able to make loans. If they can't lend, they go out of business. Ms. McWilliams.
Certainly, it's a great question, Congressman, and I have to tell you, I met with an MDI in California, which was one of the last MDIs de novo granted before the crisis, and they said, looking at historic losses, we don't have that data. We will actually have to borrow data from our peers to estimate. So it highlighted for me the issue of how complicated this is going to be for some of the smaller banks, especially the ones that don't have a long history, to do exactly what FASB is asking them to do.
And that's why, you know, there are times, FASB's got wonderful people there, but they're off target here. This thing is very devastating. The smaller community banks, our credit unions, they're the ones, they're the backbone of our towns and our cities, communities, not the larger banks, the J.P. Morgans, the Goldman Sachs. It's not going to affect them, but it will put our credit unions and our small banks out of business. Mr. Hood.
Yes, sir, I share that very same concern. We, as a agency, we regulate currently 529 MDIs. I would like to see them continue. As I mentioned in my opening statement, I will be presenting a new de novo minority depository institution with a new credit union charter just on Monday of next week. I want to make sure it has the resources to succeed, but in this age of what's taking place with CISO, it does keep me up at night, and it's going to take a lot of research and studying with all the stakeholders such as you and others to really make sure our communities don't suffer.
Well, that's great. I hope, Chair Lady Waters, that if necessary, we may need to pass legislation or something to put a stop to this. Mr. Ottinger, good to have you with us, and appreciate you and I sitting together over the last couple of years, I believe, and in your appointment, and concerning the fintechs. And we have discussed our FinTech Act. It's a bipartisan act that myself and Congressman Barry Loudermilk are working on, and it deals with the regulation there. It would be good if you could tell us the status. The last we heard was that you're extending a special order to the fintechs for regulation. Can you bring us up to date on the status of that special order?
Sure, Congressman, thank you very much. Well, first of all, we think the ability to bring new concepts and choices for consumers are important to the future of banking. What we found is a big part of the small ticket consumer and small business lending is being done by the internet. And a lot of those entities want the ability to operate across a national platform to bring those services. So what started under Comptroller Curry in 2015 was a way, could we create a national banking charter to allow those entities to be regulated, to be supervised, to have capital and liquidity and risk management like other banks? And so we went through that journey, and last year we announced that we would consider to take applications for a national bank fintech or a special purpose.
The gentleman's time has expired. The gentleman from
Thank you very much.
Mr. Duffy is recognized for 5 minutes.
Thank you, Madam Chair. Just want to make a quick comment on the chairwoman's questions to the panel in regard to the BB&T and SunTrust merger. I guess it would be my opinion that you should gather all the appropriate information, have as many public hearings as you think are necessary, gain as many comments as possible, and then make an appropriate decision. But the thought that I want to go through the process, maybe like how we build roads, where it takes 5 or 10 years to get an approval, I don't think that should be your model for approving mergers. Get the information, make a decision, and I trust that you all are doing that. But in regard to the chairwoman's comments in regard to consolidation, I agree with that. That's happening all across rural America. And you start to move decisions out of small communities that were vested in those communities, and decisions are made in some further off town, and I don't think that serves our communities as well. We tried to lift the burden on small community banks with S-2155, and the chairwoman voted against that. Many of my colleagues across the aisle voted against that bill to help small community banks, and I was disappointed in that. I didn't think it was a perfect bill, but the credit unions and the small bankers all were in our offices saying how important that was to lift the burden off their backs. So I just want to make a comment on that. But Mr. Quarles, quickly to you, obviously we have a private sector faster payment system. You're working on a Fedwire. It seems like the innovation has happened in the private sector with regard to faster payments. If the Fed steps in with Fedwire and we start to have some competition, I don't see how that plays out. Why not just let the private sector take this? Or what role do you see with Fedwire? Thoughts and opinions?
I mean, we're considering whether there ought to be a role for the Federal Reserve in the faster payment system. We've received a lot of comments about that. As you've said, there are strong reasons to want the private sector to be the area where there's innovation, and we have seen innovation there. If the Federal Reserve were to have an offering in the faster payments area, there are statutory standards that we have to meet to ensure that it would be on a level playing surface with the private sector. But no decision has been made, and we're considering the various comments that have.
I should correct myself, the Real-Time Settlement Network. Do you have a timeline on that?
No, we don't have a concrete timeline, but but it's under active consideration how we ought to respond.
Okay, just want to switch gears. We had a hearing yesterday on an Accountability and Pay Act. To the panel, who do you think should set the pay for CEOs? Should you all set the pay for bank CEOs or credit union CEOs? Should the Congress set their pay? Who should set their pay?
I believe the boards of
the board should. Yeah. Anyone disagree with the board should set the pay? And we're trying to look at ratios in pay with regard to the highest paid and the lowest paid. And my concern is that that's used probably to bludgeon banks. And I look at pay and disparity. So what we might look at what Citibank CEO makes $25 million, a lot of money. But I'll also point out that LeBron James makes $85 million a year. And I imagine the towel boy, and you look at the pay disparity there, it's pretty extreme. George Clooney makes over $200 million a year, right? And I'm sure the PA on the set and the pay ratio is extreme. Aaron Rodgers, a great Packer, around $30 million. There's pay disparity everywhere, and I think the point is, don't we pay for performance? Doesn't the private sector say, LeBron James, some will say, we'll argue about it, he's worth $85 million, some will say he's not worth $20 million, some will say he's worth $150 million. We'll debate that, but the market sets his pay. George Clooney, Aaron Rodgers. I get concerned when we want to start playing politics with pay. I believe the private sector, the boards, should compete for the best talent possible, whether it's in their bank branches or it's for their CEO pay, and pay for the talent that the market demands. Am I wrong on that? Or should we start talking about not just CEOs, but also talk about athletes and actors and everybody that makes a lot of money? Mr.
As a lifelong Laker fan, I'm concerned about LeBron's pay. If that's,
well played, sir. Mr. Quarles.
So I completely agree with that, and particularly as to the level of pay. There is an appropriate regulatory interest in ensuring that incentives are set properly, but that's separate from the level of pay.
I'm
The
sure
gentleman
Lakers
from
fans would agree with that, too. I yield back.
Illinois, Mr. Foster is recognized for 5 minutes.
Thank you, Madam Chairman, and to our witnesses. I'd like to raise the issue of sort of the ongoing merger of banking and technology, and whether we are ready for it and what you're preparing for that. The giant bank CEOs that I talk to tell me almost to a person that they are in the process of converting their banks into tech firms over the next decade. Small banks are very worried about competition from fintech and banking by cell phone. Less visible is the encroachment of giant tech firms into things that we would consider traditional banking. If you look at, for example, Amazon offers a complete line, what appears to me to be a pretty complete line of business credit options as well as consumer financing options. These are things that would have traditionally been handled by banks before, but our regulatory system doesn't seem to be matched to this. This is not a small effect. The market capitalization of our giant banks is roughly $2 trillion. The market capitalization of our giant tech firms about twice that. And so the legitimate questions arises, given the, is, for example, Amazon too big to fail? Is it too interconnected to fail? What would be the implications to our economy of a giant disruption, either due to, capitalization problems or cyber attacks or so on? Should the standards that we hold our giant banks to also be applied to the tech firms as they more and more move into this space? And so I would first off applaud Chairman Waters for recognizing this and setting up task force on both fintech and artificial intelligence, which I will be chairing along with French Hill, my colleague for Arkansas. And so what steps are you taking to deal with this over the next decade? Just go down the line, starting with
We are evaluating the emergence of financial technology and its ability to really bring other folks into the financial mainstream. The area, though, that I have the most concern about, sir, is cybersecurity, protecting data of our consumers. So that is an area that we are remaining vigilant in as we embrace fintech.
At the FDIC, we're in the process of creating the Office of Innovation to look exactly at those issues. I have personally met with dozens of fintech companies and just ask, how are you partnering up with banks? Are there any regulatory obstacles in the way? Fintech used to be almost a dirty word in the banking world, and frankly, banks have been innovating for a long time. However, the agility with which the technology companies can move and offer products and services to consumers has bypassed and surpassed what the banks are able to do, partly because of the regulatory requirements. And we're looking through our Office of Innovation, how can we modernize both our system and to how we look at the technology companies, third-party providers, vendor management, as well as how can we modernize and use technology for the FDIC as we supervise.
No, you're also responsible for the resolution of giant failed firms.
Correct.
Have you started to think about resolution plans that may become necessary for giant tech firms as they play increasingly in banking without, and as clear capital rules, for example, and many other issues?
Those are not within our statutory jurisdiction, sir.
So that at present, you're unaware of anyone that's looking at comparable?
It wouldn't be the FDIC.
All right.
Congressman Foster, as we discussed when I came over and spent some time with you, I think our biggest challenge that we continue to focus on is the partnerships that these technology firms are establishing with banks and make sure that we have clear standards around what those relationships should look like. I do echo Rodney's comments about cybersecurity. It is the one area that does, keep us up, I think, at all the agencies to make sure that we're on top of that and the impact that has on consumers today in the event that they couldn't go and get access to their ATM or credit cards in this environment for the lack of cash. So we also have an Office of Innovation that I know has been over to speak many times with your people, and we're using that as an inflow of resources when people want to consider either entering the banking industry or partnering with the banks.
Thank you. So in addition to endorsing everything that my colleagues on the panel have said, the Federal Reserve, in thinking about these questions, and particularly the long-term implications of these questions, has an unparalleled research capacity, and we have used that capacity to think about how the growth and evolution of technology can and is affecting the growth and evolution of the financial sector, both in immediate ways but also in longer-term ways, and that will eventually inform our supervisory approach.
You also, the Federal Reserve also chairs Fdic, which is supposed to look at non-bank sources of systemic risk. And so I think that's an important area that I think everyone has to look at here. Thanks so much. My time's up and yield back.
Without objection, I'd like to enter into the record a letter from the Center for American Progress on the various deregulatory proposals advanced by Trump-appointed regulators. The gentleman from Kentucky, Mr. Barr, is recognized for 5 minutes.
Thank you, Madam Chairwoman, and to our witnesses, thank you for your service and for working for financial stability and safety and soundness of our financial system, while at the same time calibrating regulations so that we encourage and maintain economic growth. First question to Vice Chairman Quarles, in your capacity as the chairman of the Financial Stability Board, are you concerned that any of the large European banks are inadequately capitalized, and do you see or discern any safety and soundness issues with those institutions?
I think that the capitalization of the European banks actually has continued to rise. So as I look at the European banking system generally, the U.S. banking system is more heavily capitalized, but that difference has been closing over time. And so the system as a whole is not one that, that gives me systemic concerns.
Well, given that it doesn't give you concerns, given that European banks are improving in terms of their capitalization, and given that in our conversations you've acknowledged the need for a level playing field in terms of American competitiveness, why is it appropriate for U.S. regulators to exceed standards set by the Basel Committee and impose more stringent capital and liquidity requirements on U.S. firms? And obviously, I'm referring to the gold plating with respect to the GSIB surcharge.
That's something that I think that we need to consider. We need to consider it particularly in the context of additional capital regulation that has been generally agreed internationally but not yet implemented domestically, that could, depending on how it's implemented, significantly increase existing capital levels. Both I and Chairman Powell have said that we think that the loss-absorbing capacity of our system is probably about right. And so as we think about how to calibrate the various elements of our existing system, as well as what may come in the future, or what will be coming in the future, we need to think about that holistically. So I would just say we are considering quite actively how to calibrate each of these elements in order to, but we shouldn't do it piecemeal, but to look at it all together.
What one editorial comment in your response to a letter that I sent with my colleagues, 28 of my colleagues, expressing concern about the GSIB surcharge and American competitiveness, your response did reference the profitability of U.S. banks, and I just would encourage the Fed as it looks at this to not use profitability of U.S. banks with, or conflating profitability with ensuring that capital requirements are appropriately calibrated. Let me move on to Chairwoman McWilliams on industrial hemp. Just yesterday, more industrial hemp businesses in Kentucky lost access to card services when their card providers stopped offering payment services to businesses designated as CBD and hemp-derived product merchants. I've had constituent businesses tell me that their access to financial products, specifically card services, have actually deteriorated since we descheduled industrial hemp in the Farm Bill, and this obviously conflicts with congressional intent. We obviously descheduled in the Farm Bill, but also we had pilot programs that were legal under federal law in the 2014 Farm Bill. What is the FDIC doing, and frankly the OCC and the Fed, what are all of you all doing to provide guidance and clarity to banks operating under a pilot program or now operating legally under the 2018 Farm Bill to make sure that banks have the confidence that they can offer their services to hemp businesses that are legal under both state and federal law?
Thank you for that question. There is a lot of uncertainty in this space, as you know, because of the state and federal laws differing on marijuana versus hemp throughout the United States. We're conducting extensive examiner training with our examiners to make sure that they're appropriately regulating these banks and making sure that our examiners are not putting undue pressure and are understanding what's legal where. And we tell banks in general, follow FinCEN guidance on marijuana banking and hemp banking as well. And if necessary, file SARs. We believe the FinCEN guidance provides a clear path for banks what to do, and I generally say if in doubt, file a SAR, but in reality, they should be also making sure that legitimate businesses, lawful businesses have access to credit.
I'm running out of time. Let me just say it would be helpful to have a unified statement from all of the regulators clarifying that industrial hemp is different than marijuana. It is legal under federal law and state law, and therefore these businesses should have access to financial services. I yield back.
Thank you. The gentlewoman from Ohio, Mrs. Beatty, who is also the chair of the Subcommittee on Diversity and Inclusion, is recognized for 5 minutes.
Thank you, Madam Chairwoman. And to the panel, thank you for being here and thank you for your presentations. I have 3 questions I'm going to try to get through quickly. So in advance, I'm going to tell you some of the questions. I'll simply ask you to say yes or no or agree. I will start with a venture capital question that deals with geographical diversity. And this question is for most of the panel. As you will recall, in 2018, we were told, and it was noted, that 4 states saw more than 80% of venture capital investment. Those states, California, New York, Massachusetts, and Texas. While I realize many of our members come from those states, I'm from the great state of Ohio. And oftentimes, certain parts of the country, we feel that we are left behind. And I believe that we need geographic diversity when it comes to venture capital. With that said, in my district, we have some very successful venture capital incubator organizations that are in their infancy stage, like Rev 1 Ventures and another one, Drive Capital. And I'd like to see more of them. And let me just say to you, Senator Chris Dodd said on the Senate floor during the debate on Dodd-Frank, quote, "Properly conducted venture capital investment will not cause the harms at which the Volcker rule is directed. In the event that properly conducted venture capital investment is excessively restricted by the provisions of Section 619, I would expect the appropriate federal regulators to exempt it using their authorities under 619J. With that said, your agencies are currently looking at changes to the Volcker rule. Are you considering exempting venture capital from the definition of covered funds as it applies to the Volcker? And do you believe this could help to spread venture capital investment more evenly around the country? Reminding you, I come from Ohio, and it's not listed there. We'll start with you, the Honorable Mr. Quarles.
Thank you, Congresswoman. We have received a lot of comments with respect to the treatment of venture capital under the Volcker rule, under the covered funds provisions of the Volcker rule. We are actively considering them. We haven't come to final conclusions on exactly how to address that issue, but it's a serious, it is a serious issue that's under active consideration.
Go move on.
I agree it should be opened up, and I am supportive of previously being a bank where we did make those kind of investments. So I am supportive. And also, I just want to thank you for going to the OCC yesterday in the Office of Diversity and attending that. You were well received. I was behind you a couple hours on the podium, but
thank you so much. Thank you. Let me go to another question because the clock is ticking down and I want to get something in from the Honorable Mr. Hood and Mrs. McWilliams. Welcome. This is your first time coming before the committee. As our chairwoman stated, I am the Subcommittee of Diversity and Inclusion's chairwoman. I've asked this question to everyone who has come before this, and you'll see your 2 colleagues there are nodding. And it deals with OMWI. So these are yes or no. Do you know what OMWI is?
Yes, ma'am.
Okay.
Absolutely.
Okay, can you tell me, do you know who your OMWI director is?
Monica Davey is mine, and she reports directly to me.
And she said that yesterday at the hearing, very proudly.
Sal Schwartz, and I'm very supportive of his efforts at the FDIC, and we have ongoing discussions about how to improve.
And as you know, it has been very difficult for them to present data to us because many of the agencies looked at it and made it voluntary. Diversity and inclusion is huge. It is not about checking the box. It is about changing the culture of not only your organizations, but across America. Do you have any idea, this is back to all of the panel, do you have any idea of what your response rates at your agency is when we ask the questions in those reports that they send with your name on it as approving it?
With my first month in as NCUA's chair, I have not seen those reports yet.
Then we'll give you a pass. We'll go down here to Mr. Quarles.
I believe that the institutions we're responsible supervising have about a 6% response rate.
Okay. You're right, exactly. Thank you.
I don't know the exact number. We did find one of the problems was the way we were asking for that information was going through the portals, and Joyce may have spent time with you yesterday. We've talked about a new way to do that, but I thought the percentage was much higher than.
My time is up. Thank you.
Thank you very much. The gentleman from Colorado, Mr. Tipton, is recognized for 5 minutes.
Thank you, Chairman, and appreciate all of you being here. I was heartened to be able to hear some of the comments that you'd made in your opening statements. Ms. McWilliams, when you'd noted on your tour that you came to appreciate how intimately involved community banks are in the success of so many local communities. And Mr. Otting, your comments in regards to the CRA making investment in communities that need it most. Issue I'd like to be able to address a little bit today is in need for increasing broadband connectivity into a lot of our rural communities, and that I believe that it should qualify fully as a category under community development as it regards to CRA. Investments into rural build-out meet the call to aid the nation's most underserved populations. And unfortunately, in my home state of Colorado, we still have a lack of connectivity primarily within those rural areas. Each of your agencies recognize that broadband investment can be folded in under CRA requirements. But as you move forward in the process to be able to modernize the CRA regulations, I'd like to be able to encourage you to state as explicitly as possible the broadband investment for underserved communities is qualifying as a CRA activity. So would you say that it's accurate that your agency, Ms. McWilliams, I'll just start with you, is a qualifying investment for CRA activity?
I honestly don't know exactly under what circumstances it would be or would not be, but it's an issue that has been brought up to my attention, and I know some of our community banks are struggling, especially in rural counties, and it's a double whammy because in a lot of these counties that one bank is the only banking presence, so it's something that's high on my list of making sure we enable these entities to have access to broadband services.
Great, and if you wouldn't mind following up with
I will,
us
I
on
promise.
that, I'd appreciate it.
Yeah,
Mr. Otting?
you know, we do have an expertise in this in the OCC. It's on our website where people can go in and see the conditions that serves low to moderate income area. And I do think one of the points you're making is in the new look at the CRA, we plan to identify all the qualified and have those on all of our websites, so it's not even a question of what qualifies in CRA going forward.
Okay. Mr. Quarles?
Yes, I don't think that it qualifies currently, but as Controller Otting said, it underscores the importance of the CRA review that we're doing because the themes that we've had in that review have been two. One, that rural areas are particularly underserved and that the CRA has not worked as well for them, and that expanding the category of investments that can qualify for CRA is a theme that we've heard both from communities and from bankers as well.
Because I've heard with respect now, we're looking at it, we're focused on it, and we haven't really made a determination whether it qualifies. Is there interagency communication on this topic?
I don't think, as we plan to introduce the revisions to CRA, all of us will concur with public input on what should qualify. Mm-hmm. But I wouldn't say on this particular topic we haven't.
Okay.
Now it is.
Yeah.
Okay, thank you. Chair McWilliams, your agency just closed an AMPR comment period for brokered deposit rulemaking. From your analysis, would you say that that was robust and comprehensive?
The rulemaking process? Yes, we have received a number of comments. And I thought it was important when I joined the FDIC that to the extent regulations have not been revisited in a decade, 2 decades, that we're able to take a look at them given the changes in the banking channels and the digital channels that are now available that weren't available back then.
Great. Thanks, I appreciate that. And many of us on this panel do hope that the rulemaking process will be constructive and to be able to provide more certainty for many segments of the industry that have advanced since the savings and loan crisis, from prepaid accounts to sweep deposits between affiliated institutions to online services. Institutions and consumers together believe would benefit from moving away from an overly broad definition broker deposits and toward one that's going to be reflective far more of the current banking landscape that we have. Chair McWilliams, is modernizing broker deposits definition a top priority for your agency?
Yes, it is.
Great. Just kind of follow up something that we've been focused on out of our office for an extended period of time, and spoke to it in some of the opening statements in terms of tailoring regulations. Have we fully implemented the tailoring that was going to be required, particularly for small community banks under 2155? Mr. Quarles?
The implementation is not complete, but it's proceeding apace.
Yes. As we indicated, most should be completed by September 30th, and all is anticipated to be completed by the end of the year.
Right, I agree.
The gentlewoman from
Thank you.
New
Yield
York,
back.
Ms. Maloney, who is also the chair for the Subcommittee on Investor Protection, Entrepreneurship, and Capital Markets, is recognized for 5 minutes.
Thank you very much, Madam Chairman, and welcome to all our panelists. Thank you for holding this important hearing. There are a great deal of issues that I want to talk about with all of you, and I won't be able to get to all of them. I think there are legitimate questions around the new CECL accounting standard for financial institutions, which I know Mr. Lukemeyer and many others on this committee care a great deal about, and that we need to explore in detail. And I'd like to follow up with all of you in writing with specific questions so I can get on to some other questions today. Thank you. First, I want to ask Mr. Quarles about the overhaul of the Volcker rule that the agencies proposed last year. As you know, when the regulators finalized the Volcker rule in 2013, they required banks to report a significant amount of data on their trading activities to the regulators so that the regulators could monitor whether banks were complying with this rule. You've now been collecting detailed trading data from all of the banks for over 5 years. So if there were problems with the Volcker rule in practice, almost all these problems would have shown up in the data. But when you proposed an overhaul of the Volcker rule last year, you cited virtually no actual data to support any of the sweeping changes you were proposing to the rule. Not even aggregated high-level data, none, zippo. Instead, the proposal justified nearly every significant change by citing, quote and unquote, experience with the rule, end quote, with no further explanation, no further evidence whatsoever. By my count, the agency cited their experience with the rule rather than actual data a total of 37 times in last year's proposal. I know it was 37 because I actually counted it up, and that is simply unacceptable. There is nothing in the law prohibiting the agencies from disclosing this trading data on an aggregated basis to provide transparency into this critically important rule. So my question is, before the agencies finalize any changes to the Volcker rule, will you commit to disclosing aggregated trading data to the public and in a way that properly protects confidential supervisory information and that demonstrates the need for any overhaul for the rule? Mr. Quarles?
Yeah, thank you, Congressman. That's a very reasonable request. We've received it from others as well as part of the comment process. We're actively looking into how to aggregate this data. The data as we collect it is, as you've noted, confidential supervisory information. Determining how to disclose it in an aggregated way that doesn't disclose the underlying confidential information is not an easy task, but we're actively looking at it.
When will we be able to have this data to look at?
Well, as part of our response to the comments as we receive them, we're looking as to how we could, how we could make some of this aggregated data public.
But when would that be?
We're expecting to complete this next step in the Volcker rule process over the next 60 to 90 days.
60 to 90 days. Okay. As you know, I look forward to seeing it, even if it has to be in a classified environment or whatever. We need to see it. Personally, I think it should be formatted in a way the public can also see it too. Mr. Quarles, as you know, Fed researchers have shown that the risk to banks from climate change could be substantial. And I know you and Chairman Powell both said that the Fed is using its supervisory authorities to prepare banks for climate change. But I have to say, based on what I've read, I'm a little concerned that the Fed's supervisory program doesn't rely on the most accurate and up-to-date data on climate change. So can you just clarify how the Fed actually supervises banks for climate risks?
Certainly. I think it's important to separate our supervisory program, which focuses on immediate and near-term risks to institutions, from our research program, which focuses on the longer, and that's mostly severe weather events and how banking institutions are prepared for responding to severe weather events and their risk management of that. I'm sorry, your time has expired.
Thank you. I yield back.
Gentleman from Ohio, Mr. Styrus, is recognized for 5 minutes.
Thank you, Madam Chair. I'd like to go down the line with everybody, and I know this has already been beat a little bit, but I have a little different take on it. Let's assume for a second that the FASB moves forward with CECL standards, and since you can't change FASB's independent decisions, are your agencies considering how to count CECL as part of regulatory capital or other capital in the context of the total capital that you're looking for of your institutions, Mr. Hood, and all the way down?
We are evaluating those options, yes, sir.
As the CECL implementation is phased out, we'll have the feedback from the initial stages of implementation, and we can make that decision at that time, sir.
Yes, and I think you know, as we discussed in your office, we are proposing a 3-year phase-in period of that, and how that'll, and there's no magic to that number. We said if there are other issues, we'll be happy to consider that.
Great.
And similarly, as we see the consequences of CECL during the phase-in period, we do have the tools to respond on the capital side.
Great, and I know various people have various levels of concern. I am concerned because I know that you've all responded to require capital, and while FASB is an important organization, they move so slowly that they just now got to it. So I just want to make sure that it's all done in context. So thank you for all of that. Chair McWilliams, as you know, Dodd-Frank's resolution planning requirements very complex and burdensome for financial institutions. We're almost a year into and since passage of Senate Bill 2155 that had provisions providing relief from resolution requirements for some financial institutions. Can you tell me what timeline you expect for banks under $100 billion and under $250 billion to get some clarity on what the resolution requirements are for them?
So we're well underway in that process, sir, and after several years of being able to take a look at the whole and a comprehensive plan, in some cases tens of thousands of pages, we're now able to focus more precisely on issue areas, and that's where we're targeting our relief.
Yeah, I understand. I'm asking when. I just asked for a timeline.
Soon.
Soon, that's a great timeline. If you could give me anything more specific, I'd love it.
I will, do we have a date? Not yet.
You could try to give all of us more clarity. Soon is great, but I don't know exactly what soon means, and it might mean one thing to you, and to me, soon means really soon. So I hope you'll move forward. Vice Chair Quarles, the Fed's moving closer to implementing the tailoring provisions of Senate Bill 2155. How do you plan to address industry growth and preserve the spirit of tailoring over time? With inflation and economic growth, as you know, those thresholds are eaten into every year. And would you maybe incorporate some type of inflation adjustment so that we're not here debating this again in 2 or 3 years?
In the comment process, we've received a number of comments that suggest that it's a very reasonable suggestion, and we're certainly taking it under consideration.
Thank you. I hope you'll take a serious look at that. I have a little time left. Vice Chair Quarles and Comptroller Otting, we are now, you guys are modernizing and doing an interagency process on the Community Reinvestment Act, and you probably know that many banks don't know before they make a Community Reinvestment Act investment whether they're going to get any credit for it. Do you expect the process to provide more clarity so that as institutions are making CRA investments, they'll know whether they think they can get a credit for it or not?
Absolutely. You point out, I think, a very complicated thing amongst the agencies and among geographically that financial institutions, when they don't know what qualifies, has a tendency to go to the mean and be in the most conservative. Generally, those are mortgages. We intend in the rewrite, one of the 4 principles is to be able to provide a list of financial institutions what occurred, but more importantly, allow people to come to their primary regulator when they have something they think is unique and be able to get a kind of a read on whether we think that would qualify.
I love that idea. Innovation is going to be so important in that space. Do you think, Mr. Otting, that that could actually result in more investment in low and moderate income communities?
I do.
I do too. Thank you. And are you considering CRA credits for partnerships with non-financial institutions because of so many unbanked people out in this country?
CRA credit for the partnerships or the products that come
The
out?
products as a result of those partnerships.
Yes.
I'm sorry if I wasn't clear.
Generally, a bank's a partner, and they would buy those originated products that are in low to moderate income. Then our new model does give them credit on their balance sheet for that activity.
Great. And there have been some claims that CRA examinations are too subjective. Is there going to be a move to try to make CRA examinations as objective and consistent as possible? Because obviously you have 2 different, sometimes people that say different things.
It is our goal to make the vast majority of it objective, so everybody...
I'll submit more questions in writing. Thank you. I yield back.
The gentlewoman from Michigan, Ms. Tlaib, is recognized for 5 minutes.
Thank you, Ms. Chairwoman Waters. The Community Reinvestment Act is extremely critical in combating housing discrimination, also ensuring that all Americans, every single American, has access to economic opportunities. If you look at the history of why it was created, you understand the importance of continuing it on. So I know that the Community Reinvestment CRA statute requires, quote, the banks have continuing and affirmative obligations to help meet their credit needs of the local communities which they are chartered. So, Mr. Otting, you're considering removing the assessment of branches within low and moderate income communities for CRA exams, is that correct?
That is not accurate.
That isn't? Okay, then one of the things that I've also said is you're proposing to move CRA exams to a, quote, single metric.
That is not accurate either.
Would remove ability for communities to provide comments?
Oh, absolutely.
No, you would be allowed to be able to do that?
We would, just as a point of fact, we met with 1,000 different organizations. The Fed went out for 23 geographic markets. We got 1,500 comments in the ANPR. We've taken that now into context. We're in the process of looking at writing the notice of proposed rule, and then that product will also go out for 75 days of public comment.
Okay, so Mr. Otting, one of the things that some of the partner organizations that I'm hoping you're meeting with is the National Community Reinvestment Coalition, which has been really critical for communities like the 13th Congressional District, which has, when we saw huge drops in black-owned home ownership, branches disappearing from every, corners and communities, what we call, credit deserts. And so one of the things that came back to me is that they estimated that there would be a loss of up to about $105 billion in home and small business lending nationally over some of the changes in the advance notice of proposal making, the ANPR, you're familiar with. So in my district alone, I'd be losing about $63 million. In my state of Michigan, about $1.9 billion. So some of these changes are obviously leading to some sort of impact, negative impact in regards to some of those changes. But I want to talk about your background.
Can I just comment on that for a quick second? I actually, collectively, our analysis is we expect somewhere between a 15 and a 40% increase in CRA investment. So I don't know.
I understand. And I got to tell you, the largest component of the CRA is its ability to block mergers that can harm consumers and endanger the financial system. Is that correct? Mr. Otting?
Say that one more time.
The largest part of the CRA is its ability to block mergers that can harm consumers.
No, I think the largest part of CRA is that it serves low to moderate income communities across America.
Well, Mr. Otting, while you were CEO of One West Bank, the merger with CIT Bank wasn't approved originally because it didn't meet the CRA examination, correct?
No, that is not correct.
It met the...
No, we passed our CRA. We had a satisfactory CRA.
Okay. So one of the things that, and I know Vice Chairman Quarles, you're here, the Fed didn't support the OCC's ANPR for CRA's modernization. Can you briefly tell me why?
Well, actually, that I hate to make a theme, but that's actually not correct. We didn't go out with them, but that's not in any way unprecedented for one agency to go out with an ANPR. They were going out asking questions. We went out complementarily to seek the same sort of input on potential improvements to the CRA through roundtables that were held by the various reserve banks. We held 29 different roundtables all around the country. So we were engaged really in the same process as the OCC. We just did different processes because we were different agencies, but we're working together to take all of that input and to come up with a proposal to the CRA that meets the community input and actually improves the regulation.
So is BB&T and SunTrust trying to merge? Do they, Mr. Otting?
The OCC is not involved in regulating.
No, but do you know that they're trying to merge right now? And
Absolutely. It's
and it would be the largest bank under FDIC supervision, correct?
yeah, that would be Chairman McWilliams.
Is that correct?
That has not been determined yet.
Hasn't been determined.
Correct.
Is the CRA playing a role in that?
Yes.
And are they meeting the requirements of the CRA?
When the application process is underway, we don't comment on the specific applications. They would have to submit a plan to us as to how they're going to tackle different issue areas and statutory requirements under the Bank Merger Act, and that's certainly one of the areas that we would consider.
Okay, thank you. I yield the rest of my time.
The gentleman from Texas, Mr. Williams, is recognized for 5 minutes.
Thank you, Madam Chairman, and thank all of you for coming before this committee to answer questions important to our constituents back home. The other day I was back home and I was speaking with a Vietnam War veteran, and he was in disbelief that in 2019 that we are having to push back against socialist proposals within our own government. It's hard to believe. I'd like to go straight down the line, starting with you, Mr. Hood, and ask each of you a simple question. Are you a capitalist or are you a socialist?
I support the free markets.
Are you capitalist or socialist?
Capitalist.
Thank you. Chairman McWilliams?
Sir, I grew up in communism, spent some time in socialism, and I choose capitalism.
Capitalism.
Mr. Rodney?
I wish I could give Yellen his answer. I'm a capitalist.
Well, capitalism wins again. Thank you very much. Chairman McWilliams, I would like to talk about the pending SunTrust and BB&T merger. There's nothing inherently evil or wrong about two businesses merging together. That's sometimes a great thing. There are many potential benefits, whether it be tapping into economies of scale, increasing efficiency, or greater growth opportunities that private sector management considers when deciding to combine businesses. And you know what? They may even make, don't say it too loud, they may make a profit. And that's a good thing. So the FDIC is statutorily required to review these bank mergers before they are finalized, yet some of my colleagues from the other side of the aisle are calling for greater congressional control over the process in this particular instance. So, Madam Chairman, can you talk about the rigorous review process that is undertaken by the FDIC and what you believe that Congress doesn't need to get involved in anymore?
Absolutely. So we have statutory requirements we're supposed to go through and meet under the Bank Merger Act for the size and the complexity of this merger, and those requirements require us to take a look and review the effect of the merger on bank competition, the financial and managerial resources of the existing and proposed institutions, the future prospects of the existing and future institutions, the convenience and need of the community to be served, the risk to the stability of the United States banking or financial system, and the effectiveness in combating money laundering activities by the existing and future institutions. And those are just a subset of requirements that you gave us.
Thank you. On May 13th, Treasury Secretary Mnuchin spoke before the National Association of Insurance Commissioners and recognized the challenges in implementing an international capital standard for insurance companies in the United States that are supposed to go into effect later this year. So, Chairman Quarles, as you know, the United States has the largest insurance market in the world, which has been able to flourish under the state-based regulatory regime. Can you explain why the U.S. and foreign regulators are planning on finalizing a new, unproven insurance capital standard in November if our insurance companies are currently well-capitalized, well-regulated, and thriving, and customers are benefiting?
There has been the Fed participating on behalf of what we call Team USA, which includes the National Association of Insurance Commissioners as well, and the Office of Insurance at the Treasury. has participated in those discussions, and we have created space in that international discussion about a holding company capital standard for our system, for a building block approach that would allow our system of insurance capital regulation to be recognized as equivalent. It's now incumbent on us, and we are close to presenting a concrete regulation to effect that building block approach. The NAIC is also working diligently to develop their group capital approach, and the IAIS, the relevant international body, has recognized that there is space for that in what's being done.
Okay, thank you. Technology is a wonderful thing, and when used correctly, makes a profound impact on our everyday lives. I've been in the car business for 50 years, and I've seen a lot of changes. And when I began, we had to call different banks for financing offers, which was a long, laborious process for our customers. But today, you can be approved for auto financing in real time, almost instantly. There's many similar stories in other industries as well, and there are now online small business lenders who can provide loans, as you know, in under 24 hours that traditional banks cannot offer. The OCC and the FDIC have committed to help drive innovation in these spaces. So, Comptroller Otting, how is the OCC playing a role in helping community and mid-sized institutions partner with technology companies for the betterment of the economy and Main Street businesses?
Right. Well, thank you for the question. First of all, in 2015, we introduced an Office of Innovation at the OCC that staffed a lot of incoming calls and comments. In addition to that, last year we announced that we would allow a national banking FinTech charter, a special purpose charter. We produced the criteria along that. But just as important to your point about a lot of relationships, we're finding a lot of non-banks are able to provide products and services, automobile lending, small ticket lending.
The gentlewoman from California, Ms. Porter, is recognized for 5 minutes.
They need a balance sheet to be able to supply that, and that's where banks are.
Mr. Otting, I don't know if you know this, but we have something in common, which is that we both grew up in small towns in rural Iowa, you in Maquoketa and me in Lorimer. And we all draw on our life experiences to do our jobs, which is reasonable. The Equal Credit Opportunity Act, ECOA, makes it unlawful for any creditor to discriminate against any applicant for any credit transaction on the basis of sex, race, color, national origin, religion, age, receipt of income from a public assistance program, or the applicant's exercise of rights under the entire Consumer Credit Protection Act. Tell me, should we add to that list of protected classes under the Equal Credit Opportunity Act friends from the inner city?
From what from the inner city, ma'am?
Friends from the inner city.
I don't believe so.
Last June, you appeared in front of this committee, and you were asked if you believe that discrimination exists, and you said, and I quote, "I have personally never observed it, but many of my friends from the inner city across America will tell me that it is evident today." When you said friends from the inner city, what did you mean?
I mean, when I was in California, I had tremendous outreach in communities across the greater Southern California community. And as I was out visiting with those people, people would tell me there were instances of discrimination. You may not know, Ms. Porter, you do know my background, but my in-laws are first-generation Hispanic people in this country. And so as I meet with them—
Do they live in the inner city?
Pardon me?
Since you've raised the issue of your in-laws,
Yes.
do they live in the inner city?
They do.
So by friends in the inner
My wife was born in
city,
the inner city of Los Angeles.
you were referring to—
I was referring to my entire experiences, as you referenced, with friends and family and people that I interact with on a consistent basis.
Who are some of your friends from the inner city besides your in-laws?
John Bryan is one of my closest friends. And John, as you know, was grown up in Compton, California, has done an incredible job, I think, with his organization of being able to build something that gives back to his community. And I have been a longtime supporter of those activities that John conducts.
So by friends from the inner city, you meant Black people, poor people, brown people. Why didn't you just say my experiences with
I just
Those who
I
suffer
chose- I
discrimination in this
chose
country.
those words at that particular point in time.
Okay. When I wrote to you on April 1st, I asked you to answer questions about the Community Reinvestment Act. I sent you this letter, it's 4 pages long, and this is the letter that I got back. Dear Representative Porter, thank you for your letter dated April 1, 2019. I intend to carry out my duties as Comptroller of the Currency. Would you like to expand upon your reply?
I would not.
Let me continue. This is the entirety of the letter. After you say, I intend to carry out my duties as Comptroller of the Currency. On a related note, it is disappointing that you have repeated on Twitter unfounded, inaccurate allegations, and you go on to say, as a member of Congress, you have a responsibility to avoid repeating misinformation. Such misinformation undermines both public and private dialogue to make CRA regulations work better for everyone. So since you don't want to expand upon your letter, you didn't reply to my substantive questions, I'm now going to ask you these questions in this hearing. Bank of America, JP Morgan, Chase, Wells Fargo, and other banks have the same relationship pricing promotions that Citibank used. Citibank had a fine, which you then dropped, levied against them for preferential treatment of white borrowers in offering home loan discounts. What have you done, drawing on your experience with friends from the inner city, what have you done to examine potential fair lending violations with regard to relationship pricing arrangements at other financial institutions?
We have a fair lending examination at all the major institutions on an annual basis, and we validate and look at all of their processes and programs, and we expect the institutions to do an end-to-end analysis of that. And where there are instances where we find that there are violations of fair lending, we refer those to the Department of Justice.
The gentleman from Arkansas, Mr. Hill, is recognized for 5 minutes.
Appreciate the chair's time. Appreciate the panel. I want to thank this panel for their devoted service to the United States. Appreciate Director McWilliams being a distinguished citizen of our country now, having survived the fall of the Berlin Wall and her experience growing up in Central Europe. So it's an honor to have you here before us. And I want to commend the FDIC and the OCC on recent innovation initiatives that I believe will be of benefit to our depository institutions and to non-banks alike. Appreciate your leadership on that. Chair McWilliams, your FDIC Innovation Lab is a great step forward, and I encourage you to select someone from that office to be running it, managing it as soon as possible. Mr. Lynch and Dr. Foster and I look forward to collaborating together on issues surrounding fintech and artificial intelligence as it relates to the financial services industry. And so much of that is exactly what you're doing in each of the regulatory agencies to maintain a level playing field, maintain access to customers, business and consumers, as well as facilitate innovation inside a giant bureaucracy like our regulatory agencies. So appreciate that. And Comptroller Otting, I appreciate also your innovation pilot program is a strong step forward, fostering a good dialogue between our banks and those, their regulators. So thank you for that. I was interested in the CECL discussion. I won't belabor it, but I just want to call your attention to Mark Zandi, who is a frequent testifier before Congress. I'm not sure actually how he gets any work done. He's on the Hill weekly. But when he testified on the subject of CECL under a number of questioners, he said, well, I don't anticipate the banks actually having to make any adjustment to comply with CECL. Well, now that just begs the question, then why is FASB proposing this? And that really sent I think, a lot of confusion in our committee on a bipartisan basis, that we've changed FASB, we're supposed to go to expected losses. Bankers don't really know quite what that means. And we would say, and I think Mr. Lukemeyer would say, we're not sure Fannie Mae and Freddie Mac know what that means, or any other entity that's got to require be required to comply with CECL. So, but a lot of us don't agree with the question I heard about creating a regulatory form of capital and a GAAP definition of capital. That's something we got away from after the savings and loan crisis in the 1990s. So while I can't encourage that, I can certainly echo the encouragement from Mr. Luchtmeyer that we, among our regulatory agencies, press FASB for that cost-benefit analysis and a delay, if necessary, in implementing this proposed pronouncement, including checking in with your friends who are commissioners at the Securities and Exchange Commission that oversees FASB. One thing I'm concerned about, having read the Treasury report on financial innovation that came out last summer, on behalf of Chair Lynch and Chair Foster and myself, I hope you will spend some staff time and prioritize for us. I know you contributed to that study, but if you would prioritize issues in lending and payments and reg tech and submit those to our FinTech task forces, I think that would be helpful. And one thing that's concerning, I think, to banks of all size is standards in innovation, that you all get on the same page. We love you that you're doing sandboxes and that you're going to try to facilitate sandbox testing within your regulatory agencies. We encourage you to move faster on that, Mr. Quarles, as it relates to AML sandbox that I know you have a request pending on. But we need you on the same page when it comes to exam guidance. So I would encourage that Fdic participants, the FFIEC, also meet and see what they can do now to harmonize on exam guidance for vendor due diligence for fintech companies. I think it's pretty good if you're at JP Morgan Chase. I think it's very difficult at a non-member state bank exam at the FDIC to get through a vendor due diligence on an emerging technology. That was a big part of the Treasury study. So will you each commit that you'll devote some FFIEC time to exam guidance, even now as we're just on the front end?
Yes, sir, I commit, and I'm the incoming vice chair of Fdic, so I will especially look forward to it.
Director McWilliams?
Yes, and I'm an outgoing chairman of FFIEC, and I intend to continue.
Hand the baton off correctly. I yield back, Madam Chair. My time's expired.
Thank you. The gentleman from Utah, Mr. McAdams.
Thank you, Madam Chair.
Recognized for 5 minutes.
Thank you, Madam Chair, and good morning. I'm happy to have you all before us today, and thank you for your testimony. My question starts with Chairwoman McWilliams, and I want to ask you about a type of bank regulated by the states and by the FDIC, and those are industrial loan companies known as industrial loan banks in my state of Utah. For decades, the FDIC quarterly call reports document ILCs are among the safest and soundest financial institutions in the country, yet some suggest that ILCs are underregulated and that the FDIC does not have the authority to provide ILCs or their parent companies with the necessary supervision to ensure that they operate in a safe and a sound manner. So, Chairwoman McWilliams, does the FDIC have the authority it needs to properly regulate ILCs, and can you describe for us what powers you have to examine an ILC and take action against it or its parent company, if necessary?
Yes. Yeah. Thank you for that question. The short answer is yes, we have the appropriate authorities to appropriately examine and supervise ILCs. We also work with the state supervisors. In fact, I have met with a great gentleman from your state who is a superintendent, and we feel that we're appropriately positioned to be able to enforce the existing laws and regulate ILCs.
And would you approve an ILC's application for deposit insurance if you believed it would put the deposit insurance fund or the financial system at risk?
Well, I don't engage in hypothetical, and that's when it's absolutely no.
Okay. I want to move to a different topic then. I want to ask a few questions regarding the Community Reinvestment Act and CRA reform for whoever on the panel may feel inclined to respond. As the Fed, the OCC, and FDIC work on proposing updates to CRA regulations, I hope that you can all preserve the spirit and intent of the CRA to benefit low and middle income communities and individuals while also updating the CRA for a 21st century financial system. So a couple of points that I hope to see in CRA reform and then some questions. As you consider CRA reform, I hope that you all look for ways to push financial institutions to innovate, to try new data-driven projects while giving those institutions the certainty that they need that innovation will be permitted under the CRA for credit. And I hope that we can reform the CRA to be more outcomes-driven rather than input-driven. and I hope that we don't lose the community-driven purpose of the statute. So, as I said, a couple of questions. The advancement of technology is widely cited as one of the drivers of CRA reform. How can regulators balance widespread adoption of electronic and mobile banking with the CRA statutes focus on local communities, and how should branches, banks, or bank-like banks be addressed?
I'd be happy to address that. Thank you very much for that question, and I appreciate your insight to this and would love to follow up and have some dialogue with you on this. As we look at the branchless institutions, and a lot of those are located in Utah, as we've talked to them about what their thoughts were, a lot of times they say we want to be able to serve more where our customers are. So giving them the flexibility not only to serve at their headquarters or where their charter is, but looking through their customer base and being able to serve those communities across America. And that's one of the goals that we're trying to accomplish.
Thank you. I've spoken to many banks about the Community Reinvestment Act, traditional banks that do fintech partnerships, and many of Utah's industrial banks. And one of the things they tell me is that it takes also too long to receive feedback from regulators after a CRA examination has taken place. Does it make sense to get word back to banks sooner so they can make needed adjustments and so they can better focus on serving the credit needs of their communities? And will CRA reform efforts touch on this point?
I absolutely 100% agree with you. I think across all three regulators, we can do a better job of that. And partly it's the subjective and ambiguous way that it's done today. And if we can bring a more objective way that it's measured, I think we can dramatically accelerate that feedback, but also put institutions in a position where they know what the criteria is, and they can be managing that so they know that they are satisfactory or outstanding before we show up.
Thank you. I just want to, I guess, reiterate my points then. As we move to adapt to CRA for 21st century technology, I hope that we can still maintain a focus on those communities that are impacted and those communities where those banks may be physically located, because even if they're serving clients in a mobile and online fashion, they are located in a particular jurisdiction. But also as we work to our understanding and opportunities to benefit those communities that CRA is intended to benefit, or those populations that it's intended to benefit, that we might find ways to encourage better innovation and more data-driven ways rather than the safe ways that have just been kind of cookie cutter in the past. And with that, I yield back.
And I would just comment, one of the core elements of CRA is serving those communities where there are
Gentleman's
branches.
time
We
has
will not walk away
expired.
from that.
Thank you.
The gentleman from Georgia, Mr. Loudermilk, is recognized for 5 minutes.
Thank you, Madam Chair. I appreciate everybody being here. This is an important dialogue that we have, and I've got a series of questions of various topics that I think are very important to our customers and constituents back home. But first, Mr. Quarles, you and I have had the conversation in the past about the Fed's investigation or consideration of getting involved in real-time payments settlement system. I've expressed my concerns of the government competing with private industry, but Chairman Powell testified to this committee that he said if the Fed does get engaged in this activity, that the system would be fully interoperable with the private sector network. My question is, we're not hearing many details, and I don't know that there are many details on this proposed system. Without the details, how do we know that it would be fully interoperable? Have you made any progress in that direction? Do you have any updates?
We don't have details on the specifics of how it would be interoperable because it's still a proposal that's under consideration, and we're considering whether it is something that we would do at all. But if we were to proceed down that road, it would be a very transparent process. I mean, the Fed is committed to ensuring that people would understand both what we were doing and why we were doing it.
Thank you. Moving on to another subject, the state of Georgia many years ago passed legislation that effectively outlawed payday loan operations in Georgia. But what has happened recently, we've left a portion of our customer base without the ability to get small dollar loans. And usually that's a segment of society that finds difficult to find a place to borrow money that they need. In fact, a statistic came out recently that said 40% of Americans cannot afford a $400 emergency without borrowing money, but we have this gap of where people can't borrow money, and Comptroller Otting, I appreciate the OCC encouraging banks to get back into the small dollar consumer loan market. I appreciate that. My question, Chairwoman McWilliams, will the FDIC explicitly state that banks can make these loans, and when may we expect that to happen?
So it is one of my priorities at the FDIC to make sure that we can reach unbanked and underbanked. And a lot of it is that fragment of the population and low and moderate income communities that actually needs small dollar credit. So we have requested, we had a request for information that was available for public comment. We have received a number of letters. We have worked with different groups to understand what are the needs of the communities. And it is my personal belief, as well as I think a good regulatory policy, that these products be offered by banks, where we can monitor for consumer protection, and we can look for the other signs of weaknesses in the marketplace and what the banks are offering. And my preference would be that banks offer these products.
Do you have any idea of when we may see some activity in that direction?
Is soon good enough?
The same definition of soon that you told my colleague, Mr. Stivers. Okay.
We will get back to you. So we had an RFI. The comment period closed under the Administrative Procedures Act. We need to move forward under a certain timeline. And as soon as I have a little bit more information, I will circle back.
Okay, thank you. I appreciate it and follow up. And in my remaining time, I want to touch on one other issue, Bank Secrecy Act. I've got a proposed bill that would increase the CTR threshold from $10,000 to $30,000. As you all know, 15 million CTRs are submitted every year. Less than 0.5% is used by law enforcement. And what I'm hearing when I'm back in the district from small banks and credit unions is this is a huge burden on these institutions. And Mr. Hood, can you comment, is this a significant problem that you are seeing in the credit union market?
It is a significant issue, sir. Credit unions are burdened by it, and I appreciate the role that you're playing in indexing that $10,000 up to $30,000 in today's dollars. And I also believe that you're looking at doing it over 5 years. They would appreciate, especially the credit unions, having the 5-year cycles, because they would have to adjust as there are tweaks made. So I thank you for what you're proposing.
But can I follow up on that? One of the issues that we have, and I appreciate the bipartisan nature that we've addressed this, but we don't provide any immediate relief under the proposal. How much benefit would it be to maybe go to 20,000 with an indexing? Would that provide significant relief?
Anything beyond what's there today, we would greatly appreciate, and I'm sure the credit unions would as well.
Okay, thank you. I yield back.
Thank you. The gentlewoman from Virginia, Mrs. Wexton, is recognized for 5 minutes.
Thank you, Madam Chair, and thank you to the witnesses for appearing today. I represent tens of thousands of government employees and federal contractors who were hurt by the 35-day government shutdown that started in December of last year. I was encouraged to see banks and credit unions of all sizes respond by waiving fees and offering low to no interest loans to help federal workers affected by the shutdown. However, regulatory guidance from the Prudential regulators was slow to come. Not until the 20th day of the shutdown did guidance come, and then only after Chairwoman Waters sent a letter asking for it. During the shutdown in 2013, it wasn't until the 9th day of the shutdown that similar guidance was released. And let me tell you why this matters. It matters because while much of the banking industry took proactive steps to assist consumers who were affected by the shutdowns, others did not. I received many letters and emails from constituents who were affected by the shutdown in bad ways, and I want to share with you a portion of a letter from a constituent that I received in the middle of the shutdown. My husband and I recently sold our home and put an offer in on another home in the area. The profits from the sale of our old home are sitting in our bank account and are sufficient for us to afford our new home and survive for several months. The mortgage financing for our new home was all set before the government shutdown. Our closing date is set for January 28th, 2019 on our new house. Today we learned our mortgage company is denying our mortgage application because I am furloughed. They consider me unemployed and too much of a risk to finance. Now, this constituent was able to work through it all, and eventually the mortgage was able to go through, and she was able to buy the house. But it really never should have happened in the first place. So I introduced the Shutdown Guidance for Financial Institutions Act, which would require regulators to issue guidance to encourage financial institutions to help consumers and businesses affected by government shutdowns. I am loath to admit that this will be the new normal, but there's a concern that it will be. We could be looking at another shutdown this year. And I think that rather than have to reinvent the wheel each time, I would prefer that we have some preparation. For the panel, are your agencies, are you guys okay with issuing guidance prospectively that would require that banks or suggest that banks and credit unions work with their holders in order to avoid some of the bad consequences of a shutdown that was not their fault?
Personally, I commend you. I do think it's a great way to look at this and be able to put those in place for people ahead of time. We would be supportive. We're also a supporter of Congressman Waters' initiative, and we did communicate with financial institutions via the OCC those guidelines.
Very good.
And I support Mr. Otting's approach.
I support it both as a regulator and a public servant who lives in Virginia. Thank you.
Seems very sensible.
Thank you. Now, I know that it's been addressed pretty exhaustively by other members of the committee, but I do want to add my name to those expressing concern about CECL and FASB's decision to forego a cost-benefit analysis before implementing those requirements. I'm especially concerned about the impact on credit availability for low to moderate income borrowers and small businesses, and I, like many other members, have heard from banks and credit unions of all sizes, both in my district and in my state. And I do have a letter here from Capital One for the committee to add to the record if there's no...
Without objection, such is the order.
Thank you. Now, I'm concerned because FASB has created this new standard. They're requiring that there be perfect foresight on the part of the various depository agencies, and it will have significant and widespread impacts on what you guys are supposed to be regulating, but it doesn't appear that there was much communication going on with you or what the impact will be. So I know it's FASB's purview, but has any of your agencies done a rigorous analysis of the impact of CECL on credit availability?
We are continuing with our Office of Chief Economist to look into that very issue.
It's difficult because there are so many ways of implementing CECL that our hope is that with a phase-out and phase-in period, actually some of the banks, of the smaller banks, have the latest compliance date, we would be able to get the information from that first tranche of banks that are complying and understand.
But you haven't been able to do that yet?
No.
Okay. And
So the large banks are going to run parallel. They're running parallel now. We're starting to see the first output of that. And what people have said is everybody's portfolio is slightly different depending upon what products you offer and the length of those products and the type. Like credit cards are definitely much more affected than you would find from a small auto loan, so to speak. So, I think we are supportive. A number of us have met with FASB to try to see, is there a solution? That's why we came up with that 3-year roll-in period to it. And we will be more flexible on that, I think, as we move forward.
Thank you very much. I yield back.
Thank you. The gentleman from North Carolina, Mr. Budd, is recognized for 5 minutes.
Thank you, Madam Chair, and thank you to our witnesses for your time again this week. Earlier this week, along with every one of my Republican colleagues on this committee, I sent you all a letter, again with all of our signatures, and it asked that your agencies move forward in implementing several critical recommendations included in the June 2017 Treasury report. Now, the report, as you know, included recommendations for modifying financial regulations to increase efficiency and promote access to capital and credit. However, 18 months later, many key items remain unfinished, and these are regulations that your agencies have the full authority to change. I realize that under the new administration, it took some time to make sure you had the right people in the right places, but we sit here today, and in each of your roles, you've been in each of these roles for many months, and as far as I can tell, the agencies have pending proposals laid out by the previous administration. Additionally, 2 proposals issued by the Fed a year ago, one, the enhanced supplementary leverage ratio, and 2, the stress capital buffer, were left over from Governor Tarullo's time here, but they still have not been finalized. I look forward to each of your responses to the letter, the one again I sent this week, but I know that many of us are frustrated with the lack of action. Since my time's limited today, I want to focus on one item. Mr. Quarles, can you please explain quickly and give us an update on when the Fed will re-examine the GSIB surcharge and other international standards placed on U.S. firms.
So there's not a specific timeline with respect to the GSIB surcharge, but we are actively looking at, because it has to be considered in the whole complex of regulation and capital regulation, including some that have only recently been agreed conceptually and require significantly detailed implementing work to ensure that what we don't want to do is make some amendment to one element of the capital regime, be that the GSIB surcharge or any other element, and discover that we've set that at a level that is too high given something else that could be coming in later. So we want to look at this comprehensively, and that requires a great deal of work, but it is active work that's going on.
Thank you. Sticking with you, Mr. Quarles, you received a letter earlier this week from 42 senators regarding concerns about the development of the ICS, of International Capital Standards, and that was by the International Association of Insurance Supervisors. It is my understanding that the IAIS is both a member of the Financial Stability Board and also claims to act at the direction of the FSB. The Senate letter you received specifically asked you as chair of the FSB to call on the IAIS to alleviate regulatory uncertainty that the ICS, or the International Capital Standards Project, has created. And also to ask you to issue a public statement that the ICS is not intended to be a global mandate, and that aggregation approaches to capital, such as those being developed by the NAIC and the Federal Reserve, as well as other well-developed and proven capital regimes, are acceptable for the purposes of the ICS. So quickly, what is your plan to implement this request?
So I think the most effective way to ensure that the U.S. capital regime is recognized as part of the international capital standard that's being developed by the IAIS. We've accomplished half of that goal, which is to have conceptual agreement at the IAIS that a building block approach, an approach that recognizes the U.S. system, is an appropriate equivalent approach to be included. Now, the next step really to be effective is for us at the Fed and for the NAIC, the National Association of Insurance Commissioners here in the United States, to develop our building block approach, our group capital approach, the building block approach of the Fed and the group capital approach of the NAIC, to put that forward in that international discussion to fill the space that has been created for a U.S. compliant regime to be included in that. We're actively doing that. We expect to have a proposal out, as Yelena would say, soon. But we will have one soon because we recognize that the process is aiming at a November timeline. And in order to have the appropriate influence on it, we need to have our concrete proposal out soon. And we will do so.
Thank you. In just a few seconds I have left, what studies and analyses have you reviewed to inform your views about how the ICS in its current form, about how that would impact the U.S. economy or other jurisdictions?
We have staff at the Fed that is devoted to these issues, and they've looked at a broad range of data. I can provide you some of the specific data as a follow-up.
Thank you. I yield back.
The gentleman from Massachusetts, Mr. Lynch, is recognized for 5 minutes.
Thank you, Madam Chair. Thank you for holding this hearing. I also want to thank the witnesses for your willingness to help the committee with its work. I do want to follow up on the question asked by my friend from Illinois, Mr. Foster, and also it was raised by my colleague and friend French Hill regarding the special purpose national bank charters around FinTech. And I happen to be the incoming chair of the FinTech task force. So I guess the question in principle is addressed to Comptroller Otting. I've been following with keen interest this case out of New York, Vullo versus the OCC. I know that Judge Marrero just issued an opinion on that. A few takeaways just from that case is that they disagreed with the OCC's interpretation of the National Bank Act, and they also pointed to the long history that state regulators have had in terms of regulating, non-bank financial service companies, and I think they're on pretty solid ground there. The OCC proposal, the white paper that you put out, and also your position in court would basically wipe out the state regulatory scheme there for consumers. And I worry about that. They've done a pretty good job for about 100 years, maybe a little longer. And so your proposal would basically exempt these fintech charters from inquiry by secretaries of state, like in my state, who does a great job, state attorneys general across the country. It would basically wipe out that entire regulatory framework, and that's not a good thing. So as the incoming chair of this task force, I'm just curious why you tried that approach. Why not come to us? You're going to need a legislative fix. We've got a lot of people here that are very, very much interested in this topic, and I think you're wasting time by trying to ram this through, without our input or through a creative reading of the act. I think your time would be better spent in dealing with the task force. We will come back to the full membership of this committee and try to work this balance out. We want to create an innovative space where innovation can actually occur, but we also want to protect the consumer. That's the balance here. And I think, based on the history, the states have done a very, very good job and they're quick to respond. We're rather slow up here, and because of the scope of interest and the nature of Congress, I guess. So, tell me, why not come to Congress? Why not try to work something out that would satisfy the concerns of the state's regulatory system, but also, create that innovative space that we all want to provide consumers with better choices?
Yeah, first of all, congratulations on your new role. I do hope to have many interactions with you on this topic because I do think it's important. I have always been...
Excuse me, Ms. Downing, we cannot hear you up
I'm
here.
sorry. Can you hear me better now?
Yes,
Yeah.
closer to the microphone. Thank you.
Thank you. So I've always been a supporter of the dual banking system, both the state and the federal. While I do respect that judge's decision, I don't think he got that decision right. And we can debate that maybe over a cup of coffee some morning.
I'd be happy to, yeah.
And I also don't feel that...
I think Jefferson and Hamilton debated this a long time ago. On this one, I'm probably with Jefferson. I think the states have a role to play, but we can talk about that.
We'll go to the play together. So, but I also think it opens up a lot of dialogue that, at least from our perspective, that the National Bank does have that right. We also feel it doesn't wipe out the way that you described, that it does make them subject to capital, liquidity, infrastructure, and consumer laws associated with this. So it isn't a black or white, I think, situation. I have a goal to help consumers have access to small ticket credit, and I'll be happy to sit down with you and talk about how can we work together. This wasn't an intent not to work together. I think if Mr. Meeks was still sitting here, he would say, I have spent an enormous amount of time here up on the Hill talking to people about this over the last year and a half. So it hasn't been done in isolation, it's been done, but in your new role, I look forward to interacting with you on this topic.
So do I. And I think there's a wider conversation we can have. And there have been, you've offered some other, white papers that have talked about something like a regulatory sandbox where we can try some of these ideas out before we expose, the investing public to any unnecessary danger. So I yield back to the gentlelady, and I appreciate the indulgence. Thank you. I yield back.
Thank you very much. The gentleman from Indiana, Mr. Hollingsworth, is recognized for 5 minutes.
Well, good afternoon. Welcome everybody here. I really appreciate the investment of time that has been made in this hearing. And specifically, Mr. Quarles, I wanted to come back to something that Representative Budd talked about, the GSIB surcharge. And I know you and I have had several conversations about this in my office, in hearings, via letters and whatnot. But I just want to come back to the central point of making sure that we get to recalibrating this and thinking about it. I think, as you well put and well articulated, that you want to make sure that this is situated inside this holistic approach, right? But the original GSIB surcharge rule was put forth in 2015. You, to your credit and your predecessor's credit, have done a lot of work since then, right, in revising the regulatory framework such that the probability of a firm encountering issues, it's much less, and the cost to the system will be much less. You should get great credit for that work. But inside that framework, because of those changes, I think that necessitates us taking a look at the GSIB surcharge, right? As you well said, you don't want to make sure that you revise this on its own, but the other factors have already changed, making revising this all the more important and all the more timely. And I know we've had this conversation before, but I wanted to reiterate to you how important I think it is that we take a look at that. And I know that you have a holistic view, and you want to approach this in all parts, but even a really big number times zero progress equates to zero progress, right? So I really wanted to ask you, when do you think that you will be able, or others on your team will be able to undertake the review of the GSIB surcharge and understand how we might recalibrate that, whether it's coefficients or otherwise, to reflect today's external environment and the regulatory changes that have since been made since 2015?
Those are all very fair points, but as far as the timeline, all I can say is that we are looking now at this, at the complex of capital regulations as a whole and trying to determine where to calibrate each element. That includes the GSIB surcharge, but I don't have a timeline for when that process will be done.
Well, no, it is important to Hoosiers back home that it be done quickly, and I know that you will do it thoughtfully. I know you'll do it artfully, but doing it quickly matters as well. And I have been disheartened on occasion by what I think are specious arguments and saying, oh, the economy is good, right, or profits are good, and somehow that excuses us from doing the right thing in terms of building the regulatory framework, right? The right regulatory regime is right irrespective of where bank profits tend to be today. Right? And so I want to make sure that we are thoughtful about that as well.
I completely agree with you that those are not good arguments.
Thank you. I appreciate that. I appreciate saying that. Transitioning topics, really big jump, but sticking with you. I know that one of the other things that's really, really important, and you and I've talked about this before, is ensuring that all of our banks compete on a level playing field, and they compete on a level playing field, including their foreign counterparts, who may be headquartered abroad, but have an important role to play in our financial system, have an important role to play in Indiana, back where I live. And so I wanted to just ask and better understand some of the reasoning behind, because I just didn't quite get it. Given that branches and IHCs are separate legal entities, I'm just unclear how the liquidity requirements take that into account in ensuring that we get to the right outcome where banks that are headquartered domestically and banks that are headquartered abroad but play domestically have the opportunity to do so on that level playing field, the teeter-totter being equal.
So our proposal to basically base the tailoring rules, the size element of the tailoring rules on the consolidated U.S. operations, the combination of the IHC and the branch.
Right.
Was driven by our experience, particularly during the financial crisis, but also our experience since. The branches of the foreign banks did require a lot of liquidity support from the Federal Reserve during the crisis. And we've seen since the development of the IHC structure,
right.
and totally appropriately, one would expect it totally legally, but activities that were accomplished in an IHC moved into the branch because of regulation that has been put onto the IHC. Those activities, if there is some future period of stress that requires liquidity support from the U.S. through the Federal Reserve, that support will now be provided in the branch. So as we look at what is the riskiness of the U.S. operations of these foreign banking organizations, I do think that for us to put out a proposal, the right place to start was to look at the consolidated U.S. operations rather than just the IHC, but we're actively considering comments that we receive on it.
Great. Well, I appreciate that. I know that you'll be thoughtful and diligent about that. And I just wanted an affirmation. The goal is parity between the two, foreign and domestic. Is that correct? However the mechanics are to get there in the addition, subtraction, the goal is parity.
Absolutely correct. National treatment for foreign operations, for U.S. operations of foreign banks.
Thank you so much. I yield back.
The gentleman from Illinois, Mr. Garcia, is recognized for 5 minutes.
Thank you, Madam Chair. Thank all the panelists for their patient testimony and Q&A engagement. I do have a question for Mr. Quarles. The Fed issued its financial stability report last week, noting a 20% increase over the last year in leverage lending. The report stated that credit standards for these loans have diminished since last fall and highlighted that loans to firms with high amounts of debt now above previous peaks in 2007. Help us understand what a leveraged loan is when private equity firms like KKR, Bain, and Vornado drove Toys R Us, everyone remembers that, into bankruptcy. Didn't they use leveraged buyouts and debt to do so, correct?
I don't know that it was excessive. I don't know all the details of the Toys R Us story, but I don't know that it was excessive leverage. That was an investment that was made by private equity firms, and retailers in general have struggled with the move to online commerce that I think was as important a factor as the particular financing structure for Toys R Us, but I don't know all the details there. A leveraged loan is is a loan that is made to an institution to a firm that has high borrowing levels, generally secured by its assets. It differs from it's similar in economic concept, but differs in legal detail from a high-yield bond.
Well, in the Toys R Us scenario, I think it was pretty simple. Private equity loaded up Toys R Us with excessive debt. This is a great example of corporate debt gone wrong. Moving on, these risky moves by corporations in debt prompted your colleague, Lael Brainerd, as well as former Fed Chief Janet Yellen, 5 Reserve Bank presidents, and a host of regulatory experts to advise activation of the countercyclical capital buffer. Yet the Fed declined to activate the countercyclical capital buffer on March 6th. Mr. Quarles, why have you chosen to ignore experts and colleagues while simultaneously warning of the risks posed by leveraged lending?
Well, that's a decision of the Board of Governors. The majority of the Board of Governors, with only one dissent, determined that our framework for considering financial stability risk would not call for turning on the countercyclical capital buffer currently. We have a...
Do you agree with their decision?
Yes, very much so.
Okay.
We have a comprehensive and disciplined methodology for considering financial stability risks. Every quarter, we meet as a board to consider leverage in households, leverage in businesses, asset valuations, leverage in the financial sector, consider all of that together. And you look at all of that together, and financial stability risks are not high enough now to turn on the CCYB under our framework.
So you agree, and you're moving in that same direction. When questioned about leverage lending at Yale University following the financial stability report's release, you noted that, quote, while leverage lending has increased, banks are not keeping these loans on their books. Can you please translate what that means? Are you saying you're less concerned about leverage lending because non-banks are involved?
No, that's one element of understanding the potential for financial stability risk. So as opposed to the potential for leverage lending being an element of a future business downturn. You would expect financial stability risk if a change in the price of a particular asset or asset class could be amplified through the financial system in a destabilizing way, and that generally occurs when there are investors in an institution or a vehicle that is exposed to that asset that can run from that asset, essentially, that the holding institution has liabilities that are shorter than the maturity of the asset to which it is exposed. Banks are a paradigmatic example of that. The leveraged loans, however, are being originated by the banks but sold into more stable holding structures, principally collateralized loan obligations, or CLOs, that have obligations with maturities that are longer than the maturity of the underlying assets, which makes them more stable institutions. So from a pure financial stability concern, that reduces the concern.
Well, you've pretty much run the clock down, so Madam Chair, I yield
in a
back.
fascinating way.
The gentleman from Ohio, Mr. Gonzalez, is recognized for 5 minutes.
Thank you, Madam Chair, and thank you to everybody for being here and for your attention. I was captivated, Mr. Quarles. But I want to kind of piggyback on some of the comments from Mr. Hill and Mr. Lynch earlier. So a recent PwC report estimated that by 2030, AI and machine learning technologies could increase North American GDP by $3.7 trillion and could increase global GDP by $15.7 trillion. July 2018 Treasury report on fintech and innovation recommended that regulators should not impose unnecessary burdens or obstacles to the use of AI and machine learning and should provide greater regulatory clarity that would enable further testing and responsible deployment of these technologies by regulated financial services companies as they develop. So my first question is for Mr. Quarles and Otting. How do your bodies view the advancements made in machine learning and AI, and what sorts of barriers do you think are currently in place that prevent financial institutions from expanding their use?
So one is, a few things I'd say. One is it's relatively early stage technology, but increasingly, developing very rapidly and increasingly broadly available. Two, it's costly, and that is something that...
Well, that's going down, right, significantly?
It's going down, but the amount that the financial sector has to spend on technology is going up, so the cost of any particular element. But the amount that we, in part for cyber prevention, in part for keeping up with competition, very, very costly. The third, from a purely regulatory viewpoint, is one of the point of machine learning is that you develop algorithms that it can improve their predictive capacity over time in ways that you are not directing, and that indeed even the creator of the algorithm may not perfectly understand, simply know that the predictive capacity is improving over time. And from a regulatory point of view, there are consumer protection and other aspects that we need to ensure that we can, that we can appropriately regulate even while allowing that technology to develop.
Yeah, I think Randy's comments are accurate. I have a couple other observations. We have seen it start to come into the AML BSA space, right, where they'll feed in 100 violators in a particular institutions and then go through their entire client base very quickly and identify characteristics, generally high volatility of money. We've also seen it be used in the underwriting of credit process, and as Randy said, there's a little bit of we're used to seeing, what's the FICO, what's the DTI, what's the, loan to value, and the machine is making decisions on the fly, and so ability to go in and examine that is a complicated, aspect of that. But we do see lots of institutions, especially in the model area, looking at how that technology can be used. I think it has tremendous applications in the future.
Thank you. And then on the issue of data privacy, which you kind of alluded to, there's an evolving framework of regulatory requirements. Financial institutions have a responsibility and obligation to protect customer data, and to be clear, are subject to federal data protection and privacy laws, including Gramm-Leach-Bliley. Complicating factor is we have a mess of international, federal, state standards. Would love to hear, again, Mr. Quarles, what regulatory framework would you propose with respect to data and privacy? Because I think that's one of the big factors that are limiting us here.
It's a great question. I don't have a great answer for you. I mean, it's a very complex question because, because it plays internationally and domestically. I think the best I can do for you today is to say I'd be glad to work with you on this because I think it's a very important question.
Sort of shifting then to ask it a little differently, GDPR, how would you say that's done, and where would you, if you could recalibrate that or like use that as here's a line in the sand, how do you evaluate that?
One of the issues that we have run into with GDPR, to just give an example, is that purely from a regulatory point of view, it actually has impeded some of our regulation of the safety and soundness of firms because of our inability to access some data under the GDPR standard. We're working through that. I think we'll be able to work through that, but it's just an example of the unintended consequences of some data protection regulation.
Okay, thank you. And I will definitely be taking you up on your offer to have deeper discussions on this. I think this is one of the most important and interesting questions that this committee and all committees, frankly, are going to be dealing with over time. So thank you, and I yield back.
The gentlewoman from Pennsylvania, Ms. Dean, is recognized for 5 minutes.
Thank you, Madam Chair. In my limited time, I'm going to try to do 3 things. So number 1 is going to be a request regarding language. Number 2 is going to ask one of you about what we should think about the massive fines that the banks have been imposed upon. And number 3, if I can, payday lending. So number 1 is a request. Before I got here to Congress, before I came to public service, I was a teacher of writing at LaSalle University. And one of the things I told my students to beware of was euphemism. You're leaders in important roles. Euphemism in your language can be very dangerous. It can fog over what those whom you regulate. So I'll just read you a couple sentences and ask you to take the lead when you're writing, so that you can make sure that we consumers, members of Congress, and those whom you regulate understand. Sentences like operational risk is elevated as banks respond to evolving and increasingly complex operating environments. Additional factors contributing to elevated operational risk are the expected increase in mergers and acquisitions activities, as well as rising trends in fraud and attempted fraud. Operational disruptions underscore the need for effective change management when implementing. You can see there's a lack of nouns and verbs and things we can see in there. I ask you to take the lead and make it clearer for us, clearer for our consumers. We had the big banks in here a couple of weeks back. It was a very enlightening hearing, and so I don't even have a current tally. But one of the themes that kept recurring was the banks since 2008 have suffered or have been imposed upon with more than $300 billion worth of fines. And I'm wondering, what is your reaction as very important regulators to that climate? That while they came in and said they're healthy and they've reduced risk and they've streamlined and they're profitable, they have suffered fine after fine after fine. And so consumers think, well, is that just the cost of doing business? So what do you as regulators think of $300 billion plus in fines on the big ones? Bank of America, JP Morgan Chase, Citigroup, Deutsche Bank, Wells Fargo, and I can go on and on and on. Your thoughts, the alarm bells that you hear.
For me, the fine is the output of actions that we have found in those institutions we found unacceptable. While people may say the fines are just a cost of doing business, I can assure you all of us as primary regulators are in the institutions making sure that if a bank is not in compliance with consumer laws or regulations, that they are getting consent orders and matters requiring attention. And so I would say to you that at least from the OCC regulated banks, I'm very comfortable that we are on site, we are regulating those institutions, and fines are the byproduct of when we find harm in activities. And often what that is it's the output, and it's a couple years down the path when those actually occur.
And I appreciate that, and don't get me wrong, I think you're doing your job. It's just incredibly grave that these are the massive fines with industry that comes in and says we're good, we're streamlined, we're doing well. And what does the consumer actually see when a massive fine is imposed? So I'm gravely concerned about that. If that just continues, it means that you're doing your job, but they're not doing their job, since you have to impose these kinds of fines. So I worry about that. I don't know if anybody else wants to say something, but maybe I'll switch to payday lending, try to get everything in. Payday lending, I am concerned about it. Again, with the notion of language, I'm now worried that we now have these things called PALs. Short-term loans may not be a PAL to us. I'm very worried about it. I appreciate FDIC and others saying they want to make sure that there are important terms and regulations. What are you looking at in terms of the guidelines, the requirements, the regulations for short-term lending, as in interest rates, term, amounts, those kinds of things to protect consumers?
Representative Dean, that is an issue that we are looking at NCUA. We are looking at low-dollar loan amounts to see how we can, one, bring more people into the economic mainstream. We're looking at, are these products at a good interest rate? Are they also able to build credit so they can really have a credit score so they can be permanently a part of the banking system? What
kind of interest rates would be appropriate for short-term lending so that people don't get into a debt trap?
Very well. Well, at NCUA, we have a statutory cap of 15% of all in loan balances. Our current payday alternative loan product, though, is priced up to 28%.
Mm-hmm. Anyone else want to talk about payday lending? It is a growing market. I think it's an incredibly dangerous market. So your thoughts as regulators?
So do you want to make a comment? Just as, the short-term payday lending is under the jurisdiction of the CFPB. Most of the banks where we would be involved is when they have a short-term loan. And we've come out with a bulletin on that, and I'd be happy to send that over to you in light of the time so you could take a look at that.
That'd be great. Thank you. Thank you all.
The gentleman from Wisconsin, Mrs. Dow, is recognized for 5 minutes.
Thank you very much, and thank you all for being here today. I want to spend my limited time on 2 questions. First, Mr. Quarles, I know that many of my colleagues have already raised concerns about the international capital standards being developed by the International Association of Insurance Supervisors. I want to echo those concerns. I also want to point out that both of my state's senators, a Republican and a Democrat, sent you a letter expressing their concerns. To me, this shouldn't be a partisan issue. It's not really Democrat, Republican, liberal, conservative. I think it's about defending our insurance markets from imported and sometimes incompatible regulations. I listened to your speech you gave earlier this year, and you said the following, that much of ICS's evolution has been in the direction of a valuation method and overall framework that reflect approaches used elsewhere in the world. And then you said, this may not be optimal for the United States insurance market. Can you elaborate on what you meant there, and would importing incompatible capital standards from Europe or elsewhere harm American consumers?
Well, we have a particular capital regulation regime in the United States that is, that has supported a healthy industry over a long period of time. It's quite different from the capital regulation regime in Europe and in other parts of the world. And with the IAIS effort to develop a global capital standard is a perfectly worthy one, but is not something. All of that's voluntary. They're developing a voluntary standard, so it couldn't be directly imported into the U.S., but it also wouldn't be effective in achieving its objective if it leaves out the U.S. System, an approach that would work for the U.S. system. So they recognize that, and the negotiating team, staff from the Fed and from the Treasury and from the NAIC have, as I've said, they've created space in the process for a U.S. group capital standard to be equivalent to anything that the Europeans might use. It's now incumbent upon us to come up with the concrete implementation of that, and we are, we're in the process of doing that. It should come out very shortly.
I appreciate that, and I'd appreciate you to continue to keep us updated as you work on that important topic. I want to shift gears, Mr. Quarles, and touch base here on some of the international bank tailoring. In particular, the Fed recently released a proposal on capital and liquidity requirements for banks that have a foreign parent. I've heard from some concerns that this rule may unreasonably raise liquidity requirements for foreign banks operating in the United States. And it seemed like maybe your comments at the Senate earlier this week confirmed that point. Meanwhile, the Fed's proposing to reduce liquidity requirements on many domestic firms of a similar size. There's several foreign banks in Wisconsin that are active, in particular for consumers across the state, agriculture, small business lending. So it kind of comes to the forefront. And with multiple firms competing in the market, ultimately, consumers in Wisconsin and across our nation benefit from that competition choice and ultimately lower prices. So with that in mind, I'm concerned about what the higher liquidity requirements may have, and the Fed's proposed for foreign banks may ultimately end up hurting consumers in Wisconsin and across the United States. Could you just take a moment to explain the Fed's proposal on the higher liquidity requirements for foreign banks?
So I think the comment that I gave was with respect to the aggregate. I think we do have a calculation that in the aggregate across all of foreign bank operations in the U.S. That there would be an increase in liquidity requirements. But there's a much greater variety of business models among foreign banks of a particular size than there are among domestic banks of a particular size. And there are banks such as some of the foreign banks that are operating, that are active in Wisconsin that are pure commercial banks, really. And then there are banks of a similar size with respect to their U.S. operations, but that are, they're trading banks, they're investment banks, they have much more complicated securities operations. And so our system for banks given that diversity of business model, The system we have proposed will result in much different treatment of firms of the same basic asset size than they would for domestic banks of that same basic asset size, which will, at that, again, at the size of most of these foreign banks in the U.S., would have business models that are much more similar to each other. So I'd be happy to, to get into the discussion of the specifics of the banks that are operating in Wisconsin, but I wouldn't assume because of the aggregate effect that those banks would be affected in the same way.
I appreciate your clarification. I yield back.
Thank you. The gentleman from Connecticut, Mr. Himes, is recognized for 5 minutes.
Thank you, Madam Chair, and thank you all for being here. I want to pick up on a line of questioning that Mr. Garcia started around leveraged lending. I'll remind you that when the CEOs of the banks, all but Wells Fargo, the big banks, were here, I asked them one question, which is, what financial product or mechanism worries you the most? And not the economy, not cybersecurity, a financial instrument or mechanism. There was near unanimity around leverage lending, and in particular, it was paired with shadow banking. A number of them said that. So I want to hear a little bit more on that topic. I've had the opportunity to talk to Mr. Quarles about this, so Mr. Otting, I'll start with you, but I also want to leave, I do want to leave time for Ms. McWilliams to address the question. Mr. Quarles was soothing in addition to being captivating, and Mr. Otting, there was a change in tone that you've had on this issue. You in Las Vegas a year ago said, as long as banks have the capital, I'm supportive of them doing leverage lending, but you have the right to do what you want. I'm sure you remember that speech. A year later, in your testimony today, you say that a specific credit risk that warrants attention involves the leverage loan market. I detect a slight change in tone there. So my question, two very specific questions, and I'll ask Ms. McWilliams the same questions. Understand that you're monitoring, but are you considering doing anything with respect to banks on their balance sheets? And if not, what would it take to actually do something, take some regulatory action? Secondarily, I'm almost more discomfited by the shadow banking question. And I heard Mr. Quarles, I understand that CLOs get bought by what he calls more stable holding structures by non-banks. Problem is non-banks borrow from banks. So question number two for both of you is, I said question number one. Question number two is, what kind of visibility do you have into that exposure, that transmission line into the, from the shadow banking or non-banks? Mr. Otting?
So first of all, on the first question real quick, I still have the same position that a bank's board and management get to make a decision on their leverage lending. A couple items got left off that quote, and I said that they have to have the people, the risk management, the policies, the capital and liquidity to play in that particular space. So I still feel that today. However, I would also say the guidance that we put out as an industry, as a group of regulators, I think has helped the banking industry to stay at acceptable levels from an underwriting perspective of stuff they're putting on their balance sheet. The national banks that we regulate have about $100 billion of leverage lending on their balance sheet, and they have about $100 billion of CLO. So that's $200 billion on $12.2 trillion, so it's a little bit less than 2%. But where we are concerned, I don't have as concerned as much about the banks that we regulate as that product is created and pushed into the market. And that's what Randy commented on earlier is we've all done an enormous amount of work as primary regulators and as members of FSOC, and we continue that work about trying to understand the risk if in the event there was a 30% reduction or lack of liquidity in that market segment. So that's my comment. I hope I addressed your issue on the leverage.
You know, and I don't disagree with your words. It was just a change in tone I was pointing out. So, and you got to the second part of my question, which is, it sounds like you understand that in addition to the balance sheets, there may be indirect transmission
That's right.
out of this product. So, I do want to leave Ms. McWilliams a little bit of time to answer the same questions, but with what degree of urgency are you looking at that?
So the other thing that we've come out and had dialogue with the banks is the indirect process, and you commented on some, but I would also we also have asked the banks to look at kind of the food chain in the corporations that they deal with, that their companies are doing business with. And what I mean by that is suppliers, are they over leveraged that you could disrupt your business? Because if you have a very successful banking relationship with a company and then you don't know their supplier is highly leveraged and they go out of business, it's going to impact your company. It goes all the way down from distribution to end customer. And then the sideline, which you touched on, I think, is a lot of these funds, that are some of them are leveraged, some are not. That's where you also have additional exposure if these funds are investing into CLOs that you understand, the volume of that activity also within the balance sheet of the banks.
Thank you. Let me see if Ms. McWilliams has anything to add to that.
I will talk very fast. Most of our small banks have CLO exposures. Most of our banks would have CLO exposure or shared national credit exposure to the extent that they're engaged in leverage lending. We have just undertaken the shared national credit, so-called SNC review among the agencies to understand exactly where the underwriting terms are and what the exposures are. And with respect to the CLO exposures at small banks, they're not that great, and we're able to monitor those through our supervisory channels. With respect to your second question as to how are we looking at the non-banks in this space, we're talking to the market regulators on a consistent basis, specifically Securities and Exchange Commission as well, to make sure that they can monitor and tell us what feedback they have from their participants, and then just kind of having the aggregate picture as to where the exposures are and where we need to be concerned.
Thank you, Madam Chair. I think this shadow banking question is important. I'll take this up with the SEC, but I worry about that. Thank you, Madam Chair. I yield back.
Thank you. The gentleman from Virginia, Mr. Rickleman, is recognized for 5 minutes.
Thank you, Madam Chairwoman. As you can see, I'm dismayed that I can't have more than 5 minutes with you, but you're probably ecstatic. So I don't want to scare you off the bat, but I've done this for a while, so I did read the actual 2015 DHS SSP, also the 2017 Treasury Report, and Section 105 of the Cybersecurity Act. So, and the reason I did is because I think you guys have some real challenges. So this is not a stump the dummy thing at all as far as questions are concerned. So as I go into this, I just know that earlier, I know we were here with the CEOs, and they agreed that cybersecurity are the biggest risks and concerns. I think we talked about AI and ML, and I'll tell you, I would love to talk about that, but I think there's a bigger concern based on my background. And this is what I want to get to the heart of. And I think you guys might find this too. I found my biggest challenge in multi-intelligence or combined operations when I did that in the military and also as a CEO was information sharing. And I know that there could be some rice bowl protections or stovepipes of excellence that we deal with, as we go forward in information sharing. So when I was reading the 2015 DHS SSP, since we're near the end, to have a little bit of fun, I wanted to see how many groups were actually involved in that SSP. So I thought it wasn't too bad at first. It was the Department of Treasury, the Financial Services Sector Coordinating Council for Critical Infrastructure Protection and Homeland Security, the FFSCC, and the FBIIC, which is the Financial and Banking Information Infrastructure Committee. So I started looking under the FBIIC, and it had the Fed, the OCC, the FDIC, the NCUA with Treasury, the CFPB, the CFTC, the CSBS, the FCA, the FHFA, Fed Chicago, Fed New York, NAIC, the NASAA, SEC, and the SIPC. So when I look at the type of challenges that you might have with information sharing, reading the 2015 Act, the 2017 Act, reading Section 105 in the Cybersecurity Act, I do have some questions, and I do want, I know it was 2 minutes, but you don't have to answer it for long. Again, this is not a quiz, I promise you this. Looking at what they were supposed to do with harmonizing regulations, when I was looking at that, I think harmonization is really streamlining and getting our information sharing in place, and as far as sharing technologies, my first question to you, and you can each answer for 30 seconds, which is not very long, and that's why I wish I had more than 5 minutes with you, is how are you collectively working to harmonize cybersecurity requirements? And I can talk to you, we can start with you, Mr. Quarles, and go right down the line.
So we meet regularly principally through, or most frequently through the Fdic, as you said, the FBIIC. All of those agencies do meet to discuss cybersecurity regulations, cybersecurity risks, also to the federal government. We also regularly interact with the bank regulatory agencies frequently on issues concerning regulation, and a number of those will be cyber regulation. We work with the Treasury as well under the President's Working Group on some of the cyber risks. It's a big, you're absolutely right, it's a big task, but it is one to which a lot of resources are being devoted.
I would echo Randy's comment, and then I would also say, when we talked in your office, we've also done a number of drills with Treasury where we've taken various aspects of the industry that would be taken over by cybersecurity and what would be the playbook that all of us as regulators and the Treasury would be able to execute on.
Yes, ma'am.
Likewise, I would echo those comments as well. And internally at the FDIC, we take a look at that, at our institutions very carefully and make sure that we understand what would happen in a cyber incident.
And in my first month at NCUA, I will now make this another priority. Cybersecurity is an issue that keeps me up at night. I will be hoping to address some of these issues through my membership on Fdic.
Sir, do you think there's too many cooks in the kitchen when it comes to enough of regulatory agencies? That is a very sensitive question. You guys don't have to answer that, I understand. I don't want anybody to get, sort of scared out there, but do you think there's too many cooks in the kitchen when it comes to this?
Are you asking all of us?
I'll ask it, actually, I can ask all of you. I was just asking, the last person to answer the question, so.
I think it's great to have a number of sets of eyes looking at this. We all come from such differing points of view and perspectives. Mine looking at credit unions all the way up to the Federal Reserve looking at some of the largest institutions among us. So I think it's healthy to have differing viewpoints and different items for debate and discussion.
Now, it's been 4 years since the SSP. Do any of you think it's time to rewrite? 4 years ago, we were still using relational databases. Now we're using graph analytics, right, in a way that we've never used before. Do you guys think it's time for a relook at the DHS SSP from 2015 and also the 2017 Treasury report? And I'll have Mr. Otting, actually answer that question.
Have we looked at it?
Yeah, do you think it's time for a rework on the 2015
I think
SSP?
that is a long period of time, like most things, especially as fast as that is moving, that you should do a relook.
Yeah, I think harmonization, and I know we talk about integration, is probably one of the most important things. We can talk about AI and ML and technology, but I think once we get our information sharing under control and harmonize our cyber defense posture, I think we have a good way forward. Thank you.
The gentlewoman from North Carolina, Ms. Adams, is recognized for 5 minutes.
Thank you, Madam Chair, and thank you for being here today. Madam Chair, thank you for convening the hearing. I won't go into so much preliminary because I think I've heard a lot of that from some of my colleagues. I do want to follow up, though, on Chairwoman Beatty, who talked about diversity and inclusion and how important that is, and not just simply checking the box. And Mr. Hood, you indicate you're the new kid on the block. And even though you haven't had a report from your person, I'm assuming that all of you are probably aware that your numbers are low in terms of this reporting. So I guess my question is, what are your plans to increase participation in providing diversity self-assessments? That's my first question.
Monica Davey, who reports to me, runs our Office of Minority and Women Inclusion, so I will be working with her to see how we can really raise the level of participation.
All right, others?
I have made this a priority of mine as well. We have a diverse workforce, and we will continue to increase those numbers.
Sure.
And Congressman, your question was, how do we get greater participation in the survey?
Right, absolutely.
One thing that we found as we explored, with Joyce Cofield, was we were sending the data through the portal to the banks, and we would recommend next year that we sign, the leaders of the agency sign the letters with the administrators of the program, and we think that would help the participation.
Yes, sir.
Yeah, I agree with you that the participation is too low, and we make that a focus of our supervision and examination of the banks to encourage them to increase that participation. We think that's...
Okay, I taught for 40 years, and sometimes when I would give students things to do on a voluntary basis, they wouldn't do them, and we'd make it mandatory. So you all think we should make it mandatory that you do it?
Well, I think
It's a yes or no, because
yes,
I want to move on.
Yes, ma'am.
Ma'am?
I would have to figure out exactly how it would be done.
Okay.
I think we should look at what data we're asking for, and could we get that where it'd be more repetitive? So I would agree with that.
All right.
Our interpretation of the law is that we can't make it mandatory, that it is a voluntary program.
All right, thank you. So of the scarce diversity data that's been shared, what type of analysis or trends have you noticed about regulated entities' diversity and inclusion efforts? Anybody can answer that.
We've noticed that in the upper levels of the organization, there's much more representation of both female and minorities at the upper levels of those organizations.
Okay, anyone else? Okay, has any guidance been provided to bank examiners on how to evaluate or assess diversity and inclusion practices at regulated entities? Does anybody want to respond?
I'm not personally familiar with it.
Not to my knowledge either.
I would have to go through our policy statements to understand exactly what instructions.
I'll be happy to follow up.
Okay. Now, most of you indicated that you have an OMWI director and that person reports, I think you all said to you directly. Does that, are there other entities or people at your agency that may be accountable for the diversity results? Or is it just that one person?
I think our entire organization is accountable.
And for us as well at NCUA, the entire organization bears a responsibility for fostering a culture of diversity and inclusion.
Likewise at the FDIC, and it's an emphasis for senior management to increase diversity within their ranks as well.
Okay.
And similarly at the Federal Reserve.
Okay. Thank you. Thank you, Madam Chair. I'm going to yield back.
The gentleman from New York, Mr. Zeldin, is recognized for 5 minutes. We have a hard stop at 1:30, and we're not going to hold the panel over, so we're going to
The minority's
close
not
it down.
communicated with about the hard stop, and that's why I raised it with you. We don't want to hold people here longer.
No,
but-
we don't. We're going to
we
go
need
ahead
to-
with Mr. Zeldin, and then we'll talk about it later. Please, Mr. Zeldin, you're recognized for 5 minutes.
Thank you, Madam Chair, and thank you to our panel for being here today. Chairman Hood, congratulations on your recent appointment. As you know, back in March, I introduced H.R. 1661 legislation that would provide NCUA board flexibility to increase federal credit union loan maturities. Since the current regulations on maturities for credit union lending are stuck in the 1940s, this is making it difficult for hardworking families on Long Island, where I live, to get a loan for a new home or a new business at their credit union. In my district, we know who the credit unions serve. Overwhelmingly, it's our public servants, such as teachers, first responders, nurses, and law enforcement. I introduced this legislation in a bipartisan manner with another member of this committee, Congressman Vicente Gonzalez. We're also proud to have added 5 additional co-sponsors to this bill on both sides of the aisle, including another member of this committee, Congresswoman Joyce Beatty. Chairman Hood, I was excited to see in your written testimony that you stated this bill is a top legislative priority for NCUA. Can you highlight some of the benefits of this legislation as well as the potential consequences our hardworking families who are credit union members may face as a result of Congress not acting?
Well, I think for some of the issues you raised, Congressman, the fact that the shorter maturities that we have now, it is preventing many of these individuals from having access to mortgage lending opportunities, and I dare say perhaps even business lending opportunities. The more we can do to get the regulatory relief that we need to serve hardworking men and women, I'm for it. And I'd be happy to work with our members at our agency to really see if we can give more attention to the bill that you proposed.
Yeah, thank you for your powerful message today, including your written testimony and for being here. I'd like to pivot to Vice Chairman Quarles. I represent the east end of Long Island, which I would argue is the greatest congressional district in America. This time of year, it's not that hard to make that argument. It's a little more difficult in February during the nor'easters, but it's pretty nice right now. You should come visit. When it comes to many policies, especially regulatory policy, what makes sense for my constituents when it comes to ensuring their businesses, their automobiles, their families, and their homes may not make sense for constituents in a different state, in a different community. For example, almost all my constituents live in coastal communities, so the insurance products they need are going to be different than the insurance products that someone might need who, say, is 1,000 miles away inland. Vice Chairman Quarles, I commend you for your leadership on the FSB, and I agree that it's important for the U.S. to lead and to coordinate with our global economic partners, but I want to be clear that it's essential in any of those negotiations that you preserve our state-based system of insurance regulation. Can you clarify if you believe a European-style system of insurance regulation and capital standards would work in the U.S.?
I think it would be difficult to make it work in the U.S., but there's nothing that's being discussed at the IAAS that would be required to be implemented in the U.S.
And just for those who are just trying to understand the dynamics of different directions that could go with different debates that are before the committee, would you be able to talk through some of the consequences of those policies, how they would impact the insurance markets if we did go in a different direction?
Probably the most concrete is that the European-style capital regulation has made it very difficult for those companies to write annuities, which is a product that is both common in the United States and is really not able to be offered in Europe anymore.
would premiums increase? Would it be more difficult for a working family on Long Island to get auto insurance, homeowners insurance, or other products to protect their families?
It could. It's complicated calculations requiring a number of assumptions.
Yeah, no, I appreciate that. We're having a debate that happens over the course of multiple hearings, different topics, and it's a good conversation for us to be having a good debate to be had to flush out the consequences of the policies enacted by this committee. I'm happy that the chairwoman had today's hearing. I appreciate the time. I thank the ranking member for his leadership on all of these issues as well, and I'd like to yield back.
I'd like to thank our distinguished witnesses.
Madam Chair, I have a point of inquiry.
Yes.
The fact that I'm not going to be able to have my 5-minute allotted time, apparently. I'm curious if this negotiated hard stop was something that was negotiated from the panel, or is this a hard stop for yourself?
Stop for the panel. We made the commitment and we're going to keep it. If a mistake was made and you were not notified, we will deal with that later. I'd like to thank our distinguished...
Madam Chair,
I'd like to thank our distinguished witnesses for their testimony today.
That they would
Without
maybe
objection,
Madam
all
Chair,
members will have 5 legislative days
Madam Chair, we have a
within
member
which
who
to
just has a
submit
question.
additional written questions for the
Madam
witnesses
Chair.
to the chair, which will
Madam
be
Chair.
forwarded to the witnesses for their
Madam
response.
Chairwoman Waters.
I ask our witnesses to please respond as promptly as you're able.
Parliamentary
Without
inquiry.
objection, all members will have 5
Parliamentary
legislative
inquiry.
days with which to submit extraneous materials.
Parliamentary
to the chair
inquiry
for
to the
inclusion
chair.
in the record. The hearing is adjourned.
This
Madam Chair,
is a
this is-
travesty, the way you've handled this. This is absolutely absurd.